A minute to go until the start of cash equity trading. I'm Francine Lacroix in London with Tom McKenzie.
And here are your top stories. CPI tailwinds. Asia stocks follow Wall Street higher after yesterday's US inflation print fuels optimism. The Fed will downshift to smaller rate hikes. Decaying demand. Chinese exports fall for the third straight month as slumping global trade weighs on economic prospects. Plus, President Biden's handling of classified documents erupts into a political crisis with a special counsel appointed to investigate.
And Tom, this is a look for futures. So for the moment, of course, we had that inflation figure yesterday in the US easing, so we're seeing a bit of positivity. I mean, it's not huge because if you look at the FTSE and the DAX, it's pretty much flat, so we'll see how the rest of the day plays out.
Yeah, 3 straight gains for European equities. Again, as you say, how that inflation print feeds into the open today. Expectations from the markets that you get 27 basis points come end of Jan, Feb from that next meeting from the Federal Reserve. And the market's pricing in less than 50 basis points over the next 2 meetings. Are the markets getting ahead of themselves? Or is this the pace and the rate of rate hikes coming through from the Federal Reserve in the next 2 meetings? The futures, of course, have pointed slightly higher, and this is how it's reflected then in the session. The Spanish IBEX, just in the first few seconds, of course, gaining 0.1%. Here in the UK, the FTSE 100 adding 12 points. Yes, GDP data for the month of November coming in better than the estimates in positive territory, just by a very slim margin. Again, the estimates have been for a contraction for the month of November. The FTSE 100 now gaining 0.2%. Similar picture over in France on the CAC 40. And in Germany, the DAX is range-bound. We'll switch it over and see how things are shaping up across assets. The Japanese yen, really interesting, as Citigroup makes the call. And it's a bold call that next week, the BOJ, I should say, will scrap its yield curve control policy. And that as a result, rates will go higher. The yen is rallying today, 128 currently on Japanese yen. That's a gain of 0.6%. The futures in the US just pointing to a little bit of downside, just down 0.1%. Still comfortably above that 3,900 level. And the 10-year, after yields, of course, came in pretty marginally, pretty significantly yesterday on the back of that CPI print, 344 on the benchmark. Not a lot of movement in the session today. Iron ore is notable as well. This is the best week in 3 weeks, 125 per ton on iron ore, a gain of 2.7%, again, on increasing expectations that there's going to be more demand coming through from China, even as imports of iron ore for the month of December contracted. Going forward, there is expectation of more demand, and in fact, inventories and stockpiles of iron ore have shrunk as well. Francine.
Tom, let's dig deeper into some of the sectors. So I have 19 groups, of course, that make up the Stock 600. Half of them are on the upside and half of them are on the downside. So I have media, real estate, technology leading the gains, and then I have auto parts, travel, and financial services around 0.5% lower. We're also getting a bit of data that, again, gives us a clue of what the ECB could do. The main story for the next couple of weeks and months is divergence between central banks. We're talking about the divergence between ECB and Bank of England, and now it could be ECB and, of course, the Fed. We had that Spanish number coming in, harmonized a little bit better than expected. Now let's get over to the Bloomberg MLive managing editor. He is the one and only Mark Cudmore. Happy Friday. Mark, you're looking at some labor data.
Happy Friday, Fran, and good morning to you both. Yes, I am. There was the CPI data yesterday, which everyone paid a lot of attention to. I'm ignoring that, not only because I got the reaction entirely wrong, so I want to gloss over quickly, but I actually think the jobs data that came out simultaneously might ultimately be more important. So it was claims data, the best real-time indicator of the US labor market. Going back over the past 50 years, this is initial claims, and I've overlaid it with all the recessions. Now, ignore the pandemic for a second. In each of the previous 5 recessions, you can see initial claims spiked up before the recession started. And in fact, for each one, We are well above 300K in initial claims, weekly initial claims, for every single recession, and we'd spiked a lot. And that's despite the fact we had a much smaller population. You'd expect it to be a larger nominal size now. The one exception, the pandemic I mentioned, well, it was a pandemic. It's a little bit unexpected. It came out of nowhere. The economy did not anticipate it. We hadn't spiked ahead of that. However, within 2 months of the pandemic hitting, we actually went to 6,000K. Yes, so far above this chart, it's about 10 times higher than this chart. I had to chop it off because otherwise it makes everything else look like a flat line near zero. It rose 30-fold in 2 months. So yes, that is the exception that proves the rule, but it also shows how much of a real-time indicator initial claims is and what a good measure it is. Now, at the moment, the most recent reading, yesterday, same time as CPI, was 205K, below expectations again. Now, remember, every single previous recession, apart from the pandemic, it's been well north of 300K, despite a smaller population, and it's been spiking up for quite a few weeks, or quite a few months, in fact, in advance. No sign of that right now. We're still near the record lows. This is a jobs market which is extremely tight still. And if the Fed gets complacent, gets too relaxed about inflation, this tight jobs market will be a hotbed of the next wave of inflation. And I don't think the Fed can afford to do that. And that's why I think that what's priced in for the rate cuts this year is way too aggressive on the downside in yields, unless there is a deep recession that's coming. And if that's the case, then it's stocks that will suffer.
Mark, you've been consistent on this emphasis around the tightness around the labour market in the US and the implications. I want to get your views on this as well. It's a redhead crossing the terminal right now, because I know this is an aspect, or at least an asset class you've been focused on, and the implications in terms of market repricing. So the redhead is this: the Bank of Japan is to conduct additional JGB buying on January the 16th. The amount is undecided. That is after stepping into the market again, I believe twice today, with unplanned purchases, after, of course, the benchmark went above the level it set itself in terms of 10-year on the yield curve control. The yen currently at 128, so still up about 0.5%. Mark, your reaction to this news? There are some expecting that next week the BOJ could even scrap yield curve control altogether.
Yeah, the speculation around next week's BOJ has been really kind of ramped up in recent days. That's why we've seen dollar-yen follow through on the downside. In fact, dollar-yen was the biggest mover of dollar weakness yesterday post-CPI. Completely contrary to what I expected. I've got this one wrong, both the CPI reaction and particularly about dollar-yen, where I actually thought you'd see that one kind of bounce post-CPI. But it's because the market is really building into these bets that the BOJ must fold next week. We've seen that in the JGB market as well. But I think this is a reiteration from the Bank of Japan. They are not backing down just yet. They're not going to let the market win so quickly. Ultimately, they might be forced to capitulate, but probably not next week. And I think the market will be disappointed, and that's why I think yen might give back a lot of its gains post-BOJ next week.
Okay, we will continue to keep across the yen on the back of this unfolding news. The redhead again, the BOJ to conduct additional JGB buying January the 16th. Mark Cudmore's take, which is that they're not ready to pack in yet and to give up in this tussle with the markets around yield curve control. Bloomberg's MLive Managing Editor Mark Cudmore, thank you, of course, for the analysis. Let's get back to the Fed story then, particularly that CPI print. And of course, we did have reaction. The Fed likely to shift to smaller hikes after US inflation cooled in December. It came in line, of course. Several policymakers are open to a less aggressive path going forward.
I expect that we're going to raise rates a few more times this year. Though, in my view, the days of us raising them 75 basis points at a time are surely past. In my view, hikes of 25 basis points will be appropriate going forward.
Now, with forward-looking real rates positive across the curve, and therefore our feet unequivocally on the brakes, it just makes sense to steer more deliberately as we work to bring inflation down.
We don't want to replay the 1970s. We want to make sure that we're moving inflation clearly back to 2%. And that means that the Fed is going to have to maintain rates at high enough levels to make sure that inflation is moving down.
Okay, joining us now is Stephen Gallo, Head of European FX Strategy at BMO Capital Markets. Stephen, good morning. Fantastic to get you in on the back of this CPI print and, of course, what we've been hearing from Fed officials. And yes, they have suggested now, a number of voices, that you're going to get 25 basis points at the next meeting, possibly 50 basis points in total over the next two meetings. But the consistency on the message from Fed officials that rates will be kept higher for longer seems to be being ignored still by these markets. Are the markets still overly optimistic?
Well, I don't know that they're overly optimistic because, the market is expecting by the end of the year, the rates market anyway, is pricing in interest rate cuts from the Fed. So I don't know if optimistic is the right word. But there is a disconnect because we are seeing generally declining risks of an economic hard landing on both sides of the Atlantic. And of course, you have China reopening now, and yet the rates market is still pricing in a chance of interest rate cuts from the Fed in the second half of the year. I think going forward, the single biggest thing that the Fed will be looking at, other than the evolution of inflation, is financial conditions. So financial tightness or financial looseness, however you want to call it, and an aggressive loosening of financial conditions when they're trying to set policy to keep inflation under control is a problem for them. So our view is that whilst we do see the dollar falling for the calendar year as a whole, we think there are going to be a number of head fakes this year. And so for the time being, rather than selling the dollar in size aggressively right now, we prefer to wait for rallies to sell into those rallies.
Stephen, what does that mean for, and good morning, I know you're expecting a lower dollar, but how fast can it actually, could it go lower than you were expecting at the end of the year?
At the moment, it's set up to potentially weaken faster than we were expecting. And that's largely because you have this combination of the rates market, I think portions of the rates market desperately want to put on the bull steepening trade in portions of the U.S. curve. So, for example, like 2s, 10s, so they can start pricing in more aggressive rate cuts from the Fed further out. And then you have another segment of the market which thinks that the Fed is not going to be able to engineer a soft landing. Those building up in the form of dollar weakness, rate cuts being priced in. You're starting to see a lot of demand for duration, so longer dated U.S. Treasuries. So with that backdrop there, yes, I think we could move quite a bit more to the downside. That's the near-term risk for the dollar. But as I say, I think this is going to be a year of head fakes. Because, for example, if we get to 110, 115 in euro dollar quickly, and then we suddenly realize that, we're getting inflation from 6% to 5%, maybe even 4% in annualized terms, but then the move from 4% to 2% is going to be a lot more difficult. And I think when that happens, in combination with the Fed pushing back against a loosening of financial conditions, that's going to cause volatility in FX. And it's going to cause a head fake on the part of many FX investors who are pricing in a much less aggressive Fed later in the year, or even a loosening of policy.
So there's the head fake risks and the volatility maybe towards the second half of this year on the back of some of those themes playing out, potentially, Stephen. Where does that, you touched on euro dollar and the 110 call, is that based on an expectation that you do indeed get a soft landing in Europe?
Yes, partly. Europe has had a lot of things going its way, in particular the weather. That was one of the risks we were watching going into 2023. Milder weather, milder temperatures across Europe has definitely slowed the drawdown on fossil fuel supplies. So yes, it partly reflects that. But I think the more important theme here is that there are some segments of the market that are putting on these trades for not only a less aggressive Fed, but a loosening of Fed policy by the end of 2023. We don't really see it that way. We think the Fed is more likely to hold rates throughout 2023. And if you look at the call of our U.S. rate strategists, they are saying that the curve will bull steepen at some point, but they've pushed that call out into the second half of the year, not the first half of the year. So yes, I think in many respects, I think 2023 is going to be a year of head fakes for a number of investors.
All right. Stephen, thanks so much. We have a number of currencies to talk about. So Stephen Gallo, head of European FX strategy at BMO Capital Markets, stays with us. Coming up, the Bank of Japan could be set for a big shift in its yield curve policy. So we'll also have the details on that next. And this is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
Welcome back to the Open, everyone. 15 minutes into the European trading day. We did have an inflation report yesterday in the U.S. That changes things. That means there's a little bit more calm on the markets. And I have to stand corrected because I've been saying there are 19 groups out of Stock 600. I need to go back to like grade 2. There are 20 groups, of course. So thank you, viewers, for writing in and saying, you missed a sector. Now, the Bank of Japan has just announced it will buy more bonds on January 16th, but has not disclosed the amount. Now, the 10-year yield is hovering above the central bank's new ceiling. Traders are positioning for a change to the yield curve control policy next week. Well, still with us is Stephen Gallo. He's head of European FX strategy at BMO Capital Markets. So, Stephen, when you look at yen, probably the most interesting currencies getting into the next couple of quarters, what do you play it against? Is it euro yen? Is it dollar yen?
Well, I think from a policy perspective, it makes sense what the BOJ is doing. If it is true, if there's speculation of more tweaks to yield curve control, if that is true, it makes sense for them to be doing that now from a risk management perspective, because look at the counterfactual. Imagine the BOJ had attempted to catch up with the Fed in 2022. There's a very high risk, I think, that the BOJ situation would have looked very similar, if not exactly like the Bank of England situation, losing control of the yield curve, losing control of the currency. So they sat tight. But now what you have is and we pointed this out earlier in the interview, you have bond yields behaving much better. Longer term yields are moderating. Expectations for Fed tightening are moderating. Risk assets are a bit better supported. And so the BOJ, instead of kicking the can down the road, is trying to do a little bit of catch up. But I actually don't think that the biggest downside risk to dollar yen and the yen crosses is the BOJ. I think it's if we get to a point, maybe 1 or 2 months out, and market participants start to become concerned again about an economic hard landing in the global economy, which pushes more downward pressure on commodity prices, more downward pressure on long-term yields. The yen will rally in that situation. I think that's the biggest downside risk to the yen, to dollar yen, and the yen crosses. That's not our base case, but it's something that could happen. I don't think the biggest downside risk to dollar yen is Japan. In terms of what we prefer, we like a handful of currencies in the ADXY. We still think they're relatively cheap after a traumatic year in 2022. We think trades in those currencies look good funded in yen over the course of the next 1 to 2 months.
I want to switch focus to the UK and the pound, Stephen. So we had GDP data coming in for the month of November, slightly better than the forecasts. Maybe we're avoiding a recession for now. You're quite constructive on sterling, certainly if it drips below 120. What is the constructive case on the pound for 2023?
The constructive case for 2023 is that, look, the UK has had its crisis, first in, first out. Personally, I think the UK is a harbinger of future sovereign debt crises, currency crisis further down the road. The timing is impossible to predict. But the optimistic case is that inflation moderates both in the UK and at the global level, stays moderate, volatility doesn't pick up substantially inflation, and the Bank of England is able to pivot, not necessarily cut rates by the end of 2023, but start taking a much more growth-friendly approach to how it sets policy. Now, if that's the case, despite the fact that it would mean the spectrum of sterling yields will drop, we actually think that's bullish for sterling. It's bullish for risk assets, it's bullish for UK assets, and it probably will support the pound. So if the BOE is able to engineer that shift to a more growth-friendly strategy, initially there'll be a fall in sterling as the market prices out rate hikes for the remainder of the year, but we would buy that dip. The downside scenario, the really bad scenario, is if the BOE pivots and inflation is not well behaved. And in that case, I think sterling will be a major underperformer over the course of the next 12 to 18 months.
Always excellent, Stephen Gallo. There's the call on sterling then. Buy dips below 120 and sell the US dollar into rally. Stephen Gallo, head of European FX strategy at BMO Capital Markets. Thank you. Have a great weekend. Coming up, Biden says he is fully cooperating as a special counsel is appointed to probe the discovery of classified documents. We've got more on that story later this hour. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make this decision.
Welcome back to the Open. Happy Friday. 23 minutes into your European trading day. Gains of 0.4%, so a fourth straight day of gains so far across European equities. Futures, though, in the US pointing lower by just under 0.1% as markets digest that CPI print stateside and the implications for the Fed. Right, let's switch focus to what is happening in China then. Chinese exports fell by nearly 10% in dollar terms in December. That's as global demand continued to drop off. The decrease was less than expected, but the government warned foreign trade will still face pressure in 2023. For more on this, we are joined by Bloomberg's Enda Curran in Hong Kong. Enda, for you, the key takeaways from this data set then?
I think you can't look past that big drop in exports, Tom. As you know, trade in merchandise goods has been such a pillar of China's economic growth since the pandemic began, but now that story has well and truly come off the boil. Also, by the way, imports into China quite weak. That's reflecting the weak consumer story there, weak demand for either raw materials or components needed to make products in China. So the trade story is weak. It does, of course, also reflect some of the COVID disruption that was impacting industrial production towards the end of last year. But right here, right now, analysts say China seems to be navigating the move away from COVID zero, at least somewhat okay on the industrial front. Obviously, there's a public health crisis, but at least on the industrial production side, seems to be a little bit better than expected. But, you know, all told, the trade story is certainly a soft one, if not a negative one, at a time when people are pointing to bright spots for China's economy in the year ahead.
And the other story, of course, is an arm of the Chinese government set to take shares in Alibaba and Tencent. So what does this move by the government mean about their intentions?
Well, it's a pretty small stake in both Alibaba and Tencent, Francine. On the one hand, of course, it underscores Chinese the need to keep control, to have influence, have authority over these big companies. It speaks to that. But on the other hand, though, analysts were responding today or reacting today by saying, actually, it might suggest that now maybe the worst of this tech crackdown is over. There does seem to be something of a regulatory shift underway in China on so many fronts now. As I say to you, expectation of an easing of the tech crackdown. We've seen something of a move, of course, on the harsh crackdown on property developers, and of course the big move on COVID zero. All of which is pointing towards a better tone on China's economy, if not maybe financial markets. So yes, these stakes and these tech giants, of course, speak to ongoing party control and influence. But you have analysts out there today saying, making the point these are small stakes, and overall they think the worst of the tech regulatory crackdown is behind China.
Thank you so much, Enda Curran there in Hong Kong. Now, coming up, the U.S. banks are set for another quarter of bumper profits, but is the windfall nearing its peak? We, of course, preview the earnings report, then we look ahead to the wake that will be. For the moment, benchmark of global stocks heading for the biggest weekly gain since November. There's been an easing of inflationary pressure in the U.S. We also had some GDP figures out of the U.K. that were better than expected, so maybe we underestimated the resilience of this economy a touch. We'll look at BOJ with a 10-year bond yield spiking above the 0.5% ceiling. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. CPI tailwinds. Asia stocks follow Wall Street higher after yesterday's U.S. inflation print fuels optimism that the Fed will downshift to smaller rate hikes. Decaying demand. Chinese exports fall for the third straight month as a slumping global trade weighs on economic prospects. Plus, President Biden's handling of classified documents erupts into a political crisis with a special counsel appointed to investigate. So, Tom, for the moment, the markets are really liking this lower than expected inflation print.
Yeah, fourth straight day of gains across European equities, gains of 0.4%. The laggard at the moment is the DAX, up just 0.1%. The auto sector, a play there. That is the biggest loser across your sectors, and we'll have a look at that in more detail shortly. The FTSE 100, though, gaining 44 points, trading at 7,837 here in the UK. The futures in the US pointing a little lower, off about 0.1%. But, of course, you did have that rally on that CPI print. Came in line, of course, and expectations now from the markets that you get about 27 basis points at the next meeting in terms of rate hikes, less than 50 basis points over the next two meetings. But are markets getting ahead of themselves? And will Fed officials over the next few days push back on these slightly looser financial conditions? As we have a look at the sectors then, I pointed out that autos is down 1.5%. It's the leading loser across these sectors, just at 31 minutes into this Friday trading session. At the top of the list, though, healthcare, one of the defensive sectors, up 1%. Consumer products as well, getting 0.7%. And the banking sector, of course, in focus for us today. We'll get more details on that as well as those US banks come to report their earnings later today. The banking sector currently gaining about 0.4% here in the UK. Let's take a now look at, well, we talked about the sectors, but let's get more then on the US banking picture, because of course we have the likes of JP Morgan, Wells Fargo and Citi reporting later today. Francine.
Now, it's a big day for big banks as a number of major U.S. lenders are due to report earnings in the coming hours. JP Morgan, Bank of America and Citi are just a few amongst them. Now, for more, we're joined by Bloomberg's Citi editor, Catherine Griffiths, who, of course, looks at some of these bank results day in, day out. Catherine, an exciting day ahead. So what's the market looking at the most?
I think the market knows certain things going into this reporting season are very well flagged. We know that investment banking revenues are going to be terrible. We'll see no deal makers beetling off to garages to buy their Lamborghinis this year. They'll be lucky if they still have a job, frankly. But I think the really crucial thing will be loan losses. It will be whether these banks feel they can keep their loan losses flat or even maybe reduce them. But any sort of signs that loan losses are going to rise will probably be quite discouraging for where the economy is going to go in the coming months.
Okay, so loan losses are potential risk point, and we know that investment banking trading, as you say, and Jefferies was part of that mix. To what extent will the higher interest rate environment, net interest margins, be supportive for this under-pressure banking sector?
Yeah, I think it will be hugely supportive, and it has been and may still be for a while. But I think one of the worries out there is how long they continue to ride that particular train, because, of course, banks do well on net interest income because depositors kind of put up with low rates while banks charge more for loans. But actually, I think what may happen is depositors start to get savvy, look around for better rates, and that could put that under pressure.
So what are we expecting from European banks? I know we've been, covering, and your team has done a fantastic work, Catherine, putting together, a lot of the job losses, but also the zeros in terms of bonuses in Europe. Are we doing worse in Europe than US banks?
So I think, people here in London don't necessarily like to hear it, but on the whole, banks do have a tougher time here. We're just in a smaller market. It's more fragmented. Those themes are the same here, though, that they are in the US. I guess here in London, there's a sort of a huge push to try and boost London, to try and get more listings. So banks are going to love that, but they need to sort of see that turning into sort of policy that actually can help them to get listings, for example.
Okay, Bloomberg's Catherine Griffiths setting us up nicely for the next conversation as we stay on the banking story ahead, of course, of these earnings. Joined now by US financials specialist at Keefe, Bruyette and Woods, Timothy Morgan. Timothy, good morning. Thanks for joining us on an important day, of course, for your space. What does a potential peak in rates stateside mean for your banking sector?
Oh, thanks for asking, Tom. Good morning, Francine, and thanks for having me on the call. The simple story is that we're in transition, and the KBW and Stifel we're recommending a couple of key pivotal changes as we come into the new year. The first is that while last year we were very much focused on higher rates and good loan growth and what that meant for net interest income at the banks, while, as Catherine had said, investment banking really troughed last year with all the problems that we've been dealing with. As we move into the new year, we think these things have turned on their head. So we've moved our focus for 2023 into the capital markets banks. And as Catherine said, even though we're expecting a horrible quarter that's been very well flagged for the investment banks, we think that this is going to be a much better year for capital markets since last year's comps are so easy to beat. And at the same time, we believe that interest rates have started to crest. And as you reported a little earlier today, we think inflation started to crest. And so it's time to pivot. And we actually also think that for the first time in a while, it's time to come back to Europe. So we're actually recommending a big buy on European banks, especially investment-oriented banks and corporate banks.
Timothy, and good morning, does it make a big difference if you're London-based or Swiss-based for some of the calls on some of these European banks?
That's an interesting call, but as Catherine had said, because every bank in Europe is that much smaller and a bit more idiosyncratic. We've done another report where we've looked at the investment banking, corporate banking business, or universal banking business around the world, and essentially the U.S. banks are the only ones over the last 10 years that have essentially returned a good return on capital and been able to achieve multiples on their stock prices above book value. And virtually every other investment bank in the world has been subscale, struggled with too many businesses, and failed to earn their returns. So, Europe's got more structural things to address in all of its banks, and that's part of a report we've just recently published.
Yeah, Tim, as you say, look, you've downgraded, for this year at least, US banks, and you want that focus on international exposed banks. To your point around investment banking, so badly hit, of course, and Jefferies was illustrative of this. To be clear, do you expect that to turn around this year? Is the pipeline around deals going to pick up?
Absolutely, we believe so. There's, the banks have been talking all year about pent-up demand building, people that have got deals that they want to get done, but just have been waiting for market conditions to stabilize. And in the fourth quarter, as rates did stabilize and we saw credit spread starts to come down, we already have seen a nice rebound in FIC, and we believe in debt issuance already, and we think that that'll continue into the year. Obviously, this is, assuming that, the Ukrainian and Russian situation doesn't get worse than it already is, and it assumes that we're right, that inflation is cresting and we're beginning to put that problem behind us.
So, Timothy, overall, how much, I don't know whether you have a figure of how many job losses we'll see in the financial sector, both in the US and Europe, and whether that's really overdoing it.
That's a good question, and we don't forecast job numbers. And at least from I mean, we have seen some headlines like the Goldman trimming. That's interesting and idiosyncratic because Goldman, of course, has a history of trimming staff every year that they postponed essentially while we were going through the pandemic. So, I mean, there should be some trimming as a result of what's happened in investment banking, but it's not news that this quarter is going to be bad. And, I think a lot of the investment banks have been, letting people go through the year and not waiting until bonus season to get it done.
Okay, Tim, this is a line that jumped out from your notes to us. Global universal bank model is in need of creative destruction. How does that unfold in the 12 months ahead?
The bottom line is that we're already seeing it unfold with a number of the banks that have been struggling, like Citigroup, already starting to hive off businesses that they simply no longer can justify keeping in an attempt to try to improve their returns. Citi being one of the exceptions, in the U.S. group of success. And so Citi started to sell off their consumer businesses. We've seen HSBC get rid of their Canadian and U.S. operations. And we believe you should expect to continue to see, especially in European banks, for diversified banks to start narrowing on core businesses.
Which means what, significant spin-offs or just bits or like smaller units that get sold off?
Well, a good example would have been, the deal with AllianceBernstein recently, for example, with SocGen combining their forces in equities research and capital markets. So it could be anything really, from spin-outs or sales to combinations. But we just believe that we're at that stage where, after having had the help from net interest income and rates probably cresting and going the other way, that the banks now need to start taking action. Since the European banks had been even cheaper on a discount, to history than the U.S., we felt that it was a good time to be coming into the European space. So even though they have underperformed, we still think that the discounts are attractive. Interest rates are going higher, probably longer in Europe, admittedly to lower rates, but the wind is behind them to take some of these strategic actions and improve their earnings.
Tim, there's been a big bet from some of these lenders, some of these banks on wealth and asset management over the years. Morgan Stanley early out on this. Credit Suisse, of course, trying to build out their wealth management business to kind of secure that future of that bank. To what extent is there an overbet there, given the slowing growth in places like China, or is that still an area of upside for these lenders?
Well, I think the hurt that they took, Tom, on that was just simply that, while it's a more consistent revenue stream, it's recurring, and that's what the market wants to pay higher multiples for, as opposed to cyclical businesses like trading and investment banking. It's still not a perfect business, and with equity markets off 20% or so last year, the wealth business sees its revenues impacted because so much of its revenue is driven by fees based on asset values. But just because it's had a flat tire last year, it doesn't mean that it won't roll, as we recover, hopefully, through this year. We still very much like that for Morgan Stanley.
All right, thank you, Timothy Morgan, their U.S. financial specialist at Keefe, Bruyette and Woods. Now, coming up, more pressure on the U.S. president. That's as a probe widens into the classified documents found in Joe Biden's garage. We'll have plenty more on that story next, and this is Bloomberg.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
Activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open, 44 minutes into your European trading day. European stocks holding on to gains of 0.4% as they assess the outlook for the Fed on the back of a CPI print in the US that came in line with expectations. US futures, though, pointing lower by 0.1%. Let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Sam Bankman-Fried has used a blog post to deny stealing from his now bankrupt crypto exchange. The FTX founder offered one of his most detailed descriptions yet of the company's collapse as he prepares to fight fraud charges, blaming crashing markets and an attack from a rival exchange. The 30-year-old says he regrets being slow to respond to public misperceptions. The Chinese government is set to take so-called golden shares in units of tech giants Alibaba and Tencent. According to a corporate database, Beijing bought 1% of an Alibaba digital media subsidiary last month. The share structure could grant government officials influence over the industry, including the power to nominate directors. The only child of Elvis Presley has died. Lisa Marie Presley has been rushed to hospital in a Los Angeles suburb after suffering a cardiac arrest. She released 3 albums with her 2003 debut recording, selling hundreds of thousands of copies. She was 54 years old. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice, thank you so much. Alice Atkins in London with us. Now, President Biden is facing greater political pressure after more classified White House documents were found at his private residence. Now, the discovery spurred Attorney General Merrick Garland to appoint a special counsel to investigate the incident. Now, for more on all of this, let's bring in Bloomberg's Bruce Einhorn. So, Bruce, first of all, what did they find? What do we know so far? And what could be the consequences of this?
Well, what we know so far is that there were documents that were found at the office at the University of Pennsylvania of President Biden's think tank, the Biden Center, which is something he set up after he left the vice presidency. So those were documents that were discovered in November. The White House says that those documents were immediately returned to the archives the next day. Now we've heard that there's been a second find, that there were some documents found in President Biden's home in Delaware in the garage. And so with that announcement, now we also have the news that Attorney General Merrick Garland has appointed a special counsel. The special counsel here is Robert Hur, who was an official in the Department of Justice in the Trump administration. He was top aide to Rod Rosenstein, who was the #2 person in the Justice Department who oversaw the Mueller investigation. Hur then went on to be the U.S. attorney in in Maryland. He's now in charge of this investigation. As a special counsel, he has more autonomy. He's independent from the regular structure of the Department of Justice that is supposed to make it easier for him to make decisions without having to consider politics, without having that influence the way people see the decisions that he makes. The unanswered questions here: one, how did the documents get there? How many documents are there? And why did it take so long for us to find out about it?
Yeah, Bruce, what is it with all your presidents walking home with classified documents? There is the politics, though. It's inevitable, isn't it, Bruce? The politics is going to invade the space. It's already there. You have the case of Donald Trump. You have the case of Joe Biden now. Is there a difference between the two, or how similar are these two cases?
Yeah, you're right. There is an issue when it comes to classified documents, and it's unclear just what level of classification we're talking about here, because there are different categories, and so something can be secret, then something can be top secret, something can be even more super duper top secret. So we don't know what we're talking about here in terms of what the documents were that were in that office or in that garage. When it comes to the similarities and differences with former President Trump, in both cases we have documents that were in places where they weren't supposed to be. The big difference here is just what happened once these documents were discovered. So in the case of President Biden, what the White House is saying is that they immediately returned them. In the case of former President Trump, what we saw is that former President Trump had the documents in Mar-a-Lago. Once they were discovered that they were missing, wasn't wholly cooperative in returning them, kept some of them behind, argued that these documents belonged to him. Ultimately, there was a search warrant that was issued, and they found more documents there that were said not to be there originally. So I think that's one of the big differences here. We don't know what number we're talking about in terms of documents in the Biden case. The White House has said that it's a small number. It's obviously very early in this situation, so we have to wait and see just what happens next. But that is also a big difference, because in the case of Trump, we were talking about quite a lot of documents.
Right.
Okay, Bruce Einhorn, thank you very much on the update on these classified documents. Biden, of course, and his team saying that some of them were safe because they were locked up in a garage with his Corvette. Coming up, stuck with risky debt. Could Wall Street be facing the fallout of driving a flurry of mega deals during the cheap money era? We'll have the details in the big take next. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. explains currently.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
This is Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. CPI tailwinds. European stocks edge higher after yesterday's U.S. inflation print fuels optimism that the Fed will downshift to smaller rate hikes. Decaying demand while Chinese exports fall for the third straight month as slumping global trade weighs on economic prospects. Plus, President Biden's handling of classified documents erupts into a political crisis with a special counsel appointed to investigate. So we'll have, of course, all of those top stories for you, but let's check in on the markets. Now, we're actually seeing a rally across the board. Certainly, global stocks set for a weekly advance after that inflation print from the U.S. yesterday. European stock also edging higher, set for their strongest performance in about 2 weeks. U.S. equity futures pretty much falling, but really unchanged. The U.S. 10-year yield 3.4284, and in terms of big market moves, I would really point to what we're seeing with yen currently at 128.29, and if you look at that 10-year bond yield in Japan, actually spiking above the 0.5% ceiling, and there's more and more speculation that the BOJ will actually review the side effects of its ultra-loose monetary policy. So quickly, let's get onto the European map to see if there are any huge differences between the various countries. The DAX unchanged, the CAC, and of course the FTSE 100 in the UK gaining 0.5%. So the Fed likely to shift to smaller hikes after U.S. inflation cooled in December. That's the very latest from that. So let me tell you what else is going on. When we look at the Fed and when we look at exactly some of the things that we want to know about is what several policy members are saying. So let's get straight to our guest, and Christine Aquino is with us. Christine, when you look at the markets and when you look at exactly one of the main turbulence that we're seeing with how markets are interpreting what Fed officials are saying, are we going to see more aggressive and much more aggressive stance from Fed officials?
Based on the market's interpretation, that's not going to be the case moving forward. I think markets are very much trying to make sense of what the Fed's going to be doing moving forward. And I think their conclusion is that yesterday's inflation print, the fact that it is continuously cooling, will give the Fed room to at the very least, slow down its pace of rate hikes. I know that some people, particularly those who are quite bullish on risk assets, are hoping that this could actually pave the way for the Fed to start pivoting and reconsider rate cuts. Personally, I think we're a little bit far off from that, but that's certainly the direction of travel that we're seeing.
Christine, thank you. Let's also bring in Bailey Wakefield, multi-asset portfolio manager at Aviva Investors. Bailey, thank you for joining us. It's been quite a big week in terms of what equity markets are doing across the board. Are you positive, Bailey, that this will continue going forward, that we're going to have positive and encouraging news?
Well, it's definitely encouraging from the start, but there's still about 3 weeks to go until the Fed's next rate decision. We knew if we got a clear read in one way or other in yesterday's report, it probably would have been decisive. There are other indicators coming up, of course, and the market is trying to work out which of these is going to be the decider, which is why we're seeing so much scrutiny around each data release and that increase in volatility. Initially, it was quite hard to say whether this report decisively argued for 25 bits or 50, and although we can't claim victory too quickly, it does provide further evidence that we have seen peak inflation in the US. Attention, of course, is now going to turn to the Fed speakers to confirm the market's expectations. As we've seen, some categories that have pushed inflation higher over the past year have started to come down, such as energy, but services pricing is still going up, which is a lot stickier, and that core services area is something that Powell was calling attention to last month. But initially, we did see some disappointment in markets because there was probably more expectation of a more benign inflation environment. So being bang on forecast initially was more of a disappointment. And also jobless numbers are coming in slightly lower than forecast, and excuse me, that underscores that the job market remains pretty tight. But then as the market digested more of that detail and incorporated some of the speaker's comments, we saw more confidence, and overall the market has cautiously welcomed the data and sees that increased possibility of a soft landing.
Christine, when you look at some of the data, out there, so we started talking about the Fed, and of course Bailey was explaining exactly what the market's looking at. Are we underestimating or overestimating the fear factors? I mean, if we have a recession, even if we have a long protracted recession, this has been the most telegraphed recession probably in the history of recessions. What does that mean for certain asset classes?
Well, Francine, yeah, I think in terms of the risk factors, there's still plenty out there. Just looking at the data yesterday, there is still quite the discrepancy between goods inflation, which has come down quite a bit, and that is the good news, and services inflation, which really is looking quite sticky at this point. And so I think the risk there, particularly for those who are more bullish in asset classes, is that there needs to be a more, pronounced slowdown, particularly in the jobs market, right? And that usually hits home a lot harder for households and something that tends to cause a lot more pain. And so for risk assets, I think this is the danger, that we are underestimating that potential real economy impact that could flow through via job losses primarily. We haven't really seen that. We haven't really seen a wave of companies having to cut massive jobs spreading beyond certain industries, such as tech and perhaps some of the banking industry, that's kind of par for the course. But if you start seeing that spreading more widely, then that's definitely something that could give bulls a bit of pause.
Bailey, what's your take on dollar? Is this I don't know what is one thing apart from inflation that you have to get right, but is dollar going to weaken from here?
Well, what we've seen so far is that the dollar has had quite a volatile start to the year. We think that we might have seen the peak in the dollar. And of course, as we've seen different data releases come out over the past week, we've seen the dollar move in both directions. But, we have seen some more weakening over the past couple of days. And we think that if that end of hiking is in sight, that means that the dollar is going to suffer, and we have seen that peak.
Christine, when we have data points, we're having earnings. If you look at a lot of the banks, so we're looking at cost cutting. Is this the year where, we're going to see just a lot of cost cutting and so margins being squeezed because they're trying, and this is all sectors across the board, trying to hold on to their market share?
Yeah, I think that's definitely the flavor of this earnings season, Francine. Just any indication of companies trying to cut those costs, particularly in the labor market. And I think this is why, in particular, that inflation in the services sector of the U.S. economy is quite important to take note of, because, the job market is very much at the center of that. And the fact that we're seeing still, in terms of the data, a robust job market, but then indications from companies during earnings season that no, they're going to start cutting all of these positions and rethinking some of our hiring moving forward. That's quite the discrepancy, right? And that's potentially something that's yet to be priced into markets, and investors have yet to fully realize the real economy impact of that.
All right, thank you both for joining us. Christina Kino, they're a managing editor for City Latest, and Bailey Wakefield, multi-asset portfolio manager at Aviva Investors, stays with us. Coming up, U.S. banks set for another quarter of bumper profits, but is the windfall nearing its peak? We preview the earnings report next, and this is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it's a big day for the big banks as a number of major U.S. lenders are due to report earnings in the coming hours. JP Morgan, Bank of America, and Citi are amongst them. Now, for more on all of this, we're joined by Bloomberg finance reporter Tom Metcalf. He also oversees, more than a reporter, he's a reporter and he oversees all of our coverage for EMEA. Tom, thank you so much for coming on. So we look at a lot of the U.S. earnings, and I guess there's a general theme of, little bonuses, cost cuts. Like, what are you looking out for?
Yeah, definitely. All those things. Also expecting, how do they trade in Q4? But I think probably the big picture here is everyone's really now focused on the outlook. So it might be a really strong quarter for some of these banks, but people are kind of now a bit more worried about their shadow with these, possibility of recession. And that obviously then will really hit the banks hard. So I think today, especially, you'll be looking for how is Citi kind of guiding on loan losses, for example?
Yeah. So we've talked about this, before for especially UK banks, that they've just hired too much, and now we're seeing a downturn. So is it that, again, a lot of these US banks, are they predicting recession, an ugly recession, or that they just got too big?
I think it's probably more of the latter, actually. It was a real boom time the last couple of years for hiring. Goldman, I think, have grown by something like 30%. So inevitably, these job cuts are going to be painful, but when you put it against the context of, Goldman 2-3 years ago, it's sort of a bit of a blip rather than a huge change.
Tom, what are you expecting for Europe? And we had one of our guests saying, look, maybe there are opportunities in Europe because when you look at price to book ratios and things like that, they're just so much weaker. And now we're seeing the titans of Wall Street also struggling.
Yeah, exactly. It could potentially be a good time for European banks. I mean, relatively, right? Because this net interest margins, they'll be getting fatter and fatter, you'd expect. Finally, they're coming out of this low rate
environment. So in a way, they're sort of got a bit of catch up to do with the US banks. But you look back over the last few years, and that sort of valuation gap has been pretty permanent. So whether that can shrink that much, I'm not sure.
Okay, that's a good point. Also, Tom was on a great podcast with me and Dave Merritt where he explains that bonuses are going to be really tough. And he basically told everyone, if you're a banker, just go work for a hedge fund instead. So listen to that podcast with Tom Metcalf. Thank you. Now we're back with Bailey Wakefield, multi-asset portfolio manager at Aviva Investors. Bailey, we're getting into the earnings season. It's going to be 5, 6, 10 companies a day with earnings. What are you looking out for?
Well, overall, when it comes to strategy for 2023, we think it's really important to be clear on what questions need answering. And of course, we're going to find out more and more of that data as we go through earnings season. But for us, earnings is one of those key questions that we need to find an answer to. So in 2022, broadly, earnings were pointing towards fragility rather than collapse. And now we need to see whether that is still the case. Last year, earnings were more optimistic. Now we are seeing some rectifications on what the sell side predictions on earnings are coming down slightly. It's clear that now that markets are also expected earnings to come down, but we need to gauge what level of losses are going to be tolerated by the market. So we can see a scenario where even up to a 10% loss could be tolerated by markets, but what about 20%, 30%? That scenario could be something that the market isn't expecting.
So, Bailey, how do you think game theory this? I mean, are you expecting overall equities to be higher on the year with a pickup in the second half, or do you front load maybe some of the equity buys because it'll be better than expected in terms of earnings, but then could deteriorate into year end?
Yeah, I think we're more on the side of going with a more earnings resilience theme at the moment. We can see a little bit of weakness in the first half of this year. So that's why we favour more of those areas of the market that are a little bit more resilient. So one position that we continue to have conviction in is the US healthcare sector, which outperformed versus the S&P 500 by almost 20% last year. Of course, some of that was led by the defensive nature of the sector, which we expect to continue, and that earnings resilience that the sector provides in volatile environments. But that more idiosyncratic nature of the trade was also a benefit. Demographic trends remain to be supportive of the trade with aging populations, but we've seen accelerated innovation post-COVID-19.
Bailey, are we underestimating actually the impact of COVID-19 on the future for the next couple of years? So we're in a higher interest rate environment. That could be a new normal for quite some time. So the markets haven't 100% figured out, but we're still having COVID legacies.
Yeah, I think so. And it's a particularly interesting case with China. And of course, we're seeing them come out of their zero COVID policy. And I think it's going to be particularly interesting to see what the new normal for China actually looks like. In the West, we've gone back into a scenario where we'll have more working from home as well as going into the office or going into whatever industry that we work in. But we need to see what the new normal is going to look like in different places to be able to see what we're going to expect going into future years.
Bailey, thanks so much. Bailey Wakefield, their multi-asset portfolio manager at Aviva Investors. Coming up, the UK economy unexpectedly grew in November. More on the latest GDP figures up next. And this is Bloomberg.
There's an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg. Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
Well, good morning, everyone, and welcome to our daily Bloomberg UK segment. We focus on the biggest challenges facing the British government, economy, financial services, and markets. And I'm Francine Lacroix here in London. Now, UK GDP unexpectedly rose 0.1% in November as consumers kept spending through the worst cost of living squeeze in memory. Now, economists had expected a small decline for the month after growth in October. Well, joining us now is Philip Aldrich. He's Bloomberg's senior UK economics reporter. Phil, thank you so much for joining us. Now, just talk to me a little bit about the GDP number, because we were either underestimating the resilience of the UK economy, or this is just football spending, right? There was a World Cup and people wanted to host.
It's more the former. It's more the resilience, because so football gave and took away at the same time. People went down the pubs, spent more. It was a net contributor. They spent more in the pubs watching the games, but they were playing less in the sports pitches. So you had this decline in sports activities. But overall, it was the services sector that boosted growth, and so there was administration. There was recruiters were really busy, according to the ONS. So there was some genuinely positive underlying signs of some level of resilience in the service side of the economy, which is the one where people are most worried about.
So overall, we're like January, what is it, like 13th? I mean, we forget the times because we're both going to Davos. Certainly I forgot, the dates. What does it mean in terms of what BOE does? We also heard from Catherine Mann saying, look, interest rates have to go higher.
Yeah, if anything, it's going to reinforce the sort of need to continue to raise rates relatively aggressively narrative, because the Bank of England was forecasting is forecasting a recession for the final quarter of this year. It now looks like for the UK to actually dip into contraction in the final 3 months of 2022. Sorry, talking about last year. That we'll need to have seen a 0.5% contraction in the final month, in December. And actually, there's been a lot of really positive news coming out of the retailers. You've had Next upgrading its profit outlook. There's been good numbers from Tesco's and other high street chains. People have been, Ryanair and others have been talked about people buying flights and holidays. So it doesn't look like there's going to be an awfully terrible December number. So we will have skipped that recession, which basically will put more pressure on the bank to, worry about the inflation pressures within the economy, the spending pressures within the economy.
But, Phil, are you more optimistic about the future? Because you could also say, because of the overhang the COVID, basically on lockdown. People wanted to spend, and then it's this year, maybe middle of the year, when you have mortgages that are no longer fixed rate and people start losing their job, that it's crunch time.
Yeah, so it's probably, as I think people are saying, it's recession delayed rather than recession averted. But the question, I think for most people is like, if we do have a dip, like, so how severe is the dip? And there is no question that households are feeling a living standard squeeze. That is actively happening. Obviously, wages are not keeping up with inflation, and prices are rising aggressively, etc. So that story continues. So it'll feel bad. It's going to feel like recession. But there is resilience in the economy. We have unemployment still at extraordinarily low levels, and as you say, households have got this built-up savings. So there's positive things to take away at the moment.
We're both going to Davos, and I find it quite strange. So there's no chancellor, there's no prime minister, but actually it's the Labour shadow chancellor and the Labour shadow PM are going to be there, Keir Starmer. So are they trying to attract international investment? Are they trying to be seen as business friendly?
I think it's interesting because obviously there's this sort of elitist streak of Davos which sort of rubs some people up the wrong way, and so the Rishi Sunak and the government do not want to be associated with that. I mean, he's already a billionaire, so it's not something he needs to reinforce. Whereas the other side of Davos is that you do build up relations, you find potential institutional investors into the UK, and most importantly for Labour is that they need to build up their business credibility, which they have been doing quite successfully. And as a government in waiting, visiting Davos and showing that you're on the world stage is definitely a good thing. And so I think they definitely seem to be seizing that opportunity as the government kind of steps away from that scene.
Yeah, really interesting dynamics. Philip, thank you so much. Philip Aldrich there with the very latest on the UK. And we'll also be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. And next week, we actually have a Davos, maybe UK special. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sam Bankman-Fried has used a blog post to deny stealing from his now bankrupt crypto exchange. The FTX founder offered one of his most detailed descriptions yet of the company's collapse as he prepares to fight fraud charges, blaming crashing markets and an attack from a rival exchange. The 30-year-old says he regrets being slow to respond to public mispreconceptions. The Chinese government is set to take so-called golden shares in units of tech giants Alibaba and Tencent. According to a corporate database, Beijing bought 1% of an Alibaba digital media subsidiary. That was last month. The share structure could grant the government officials influence over the industry, including the power to nominate directors. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Coming up, a non-resident senior fellow in the Atlantic Council, Kidrimas Ginglagas on Ukraine.
More activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
CPI tailwinds, European stocks follow Wall Street higher after yesterday's U.S. inflation print fuels optimism that the Fed will downshift to smaller rate hikes. Decaying demand while Chinese exports fall for the third straight month as slumping global trade weighs on economic prospects. Plus, President Biden's handling of classified documents erupts into a political crisis with a special counsel appointed to investigate. Well, good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, while the war on the ground in Ukraine grinds on and the outcome really remains uncertain, many in Western capitals are beginning to consider what the European landscape will look like post-war. Now, I'm joined by non-resident senior fellow at the Atlantic Council, Gidremas Jedlinskas. He's also former Assistant Secretary General for Executive Management at NATO. So thank you so much for joining us. You were at NATO for a long time, so you've seen things. You understand strategy. How long could this war continue for?
Francine, actually, it's anyone's guess. The situation is uncertain. The war is by nature very uncertain. But I think what we have seen is that there are two determinants. One is the Ukrainians' will to fight, to persevere, which we have seen actually extremely well. We see galvanizing leadership by President Zelensky. We see the perseverance of Ukrainian people. We see the resilience of institutions. Now, I think on the other side, it's about the West, about the NATO. And what we've seen also in this past 10 months, I think, is the strengthening of both NATO and, I would argue, EU as institutions that remain relevant in this world. The support is flowing. The public support remains high. I think we're no longer talking about not sending non-lethal weapons, lethal weapons or so. It's really about supporting Ukraine as much as possible.
But is this good or bad in the eyes of, I mean, it's very clear actually that in the eyes of Vladimir Putin, this is bad, right? So he feels threatened. So what does it mean for world peace? It's good to have allies that are strong, but does it put him closer to nuclear deterrent?
Now, I think the world, one thing that's very clear is the world has changed, and we see both from NATO's side, is that it's very clear. We live in an era of strategic political competition. So we see the dividing line, which is values. This is democracies versus autocracies. So I think this fight is good because, again, the world is fragmenting along these lines, along democracies and autocracies. Now, if we look at 10 years ago, we're thinking about the China and Asia, the world economy engines of the world. Now we saw President Biden several months ago talking about, well, this century will be defined by the battle of democracies versus autocracies. So I think it's a different world. I think the West is coming together. NATO is coming together. NATO plays an essential role in really galvanizing that support in the West. And I think it is good. It is absolutely positive for the future of peace.
I was told by a senior diplomat that actually on February 24th last year, when there was, of course, Russia invaded Ukraine, the thing that Europe or the thing that NATO or the thing that the U.S. should have done is fly directly to Beijing to get them on side. What's China's role in this?
Well, I think China also chooses what it can do. I think it has chosen to support President Putin. It was right before the invasion. They announced this limitless friendship. I think, again, the world is, as I mentioned, fragmenting. I think it's the dividing line is democracies. NATO, EU, of course, led by United States, stands on one side. I think China's growth, China's military saber-rattling, what's happening around Taiwan, the sort of unlimited defense spending, the sort of unchecked nuclear exercises, it tells you that, they are on the other side. So I think, we're clearly emerging into that kind of divide.
What surprised you the most in the last 12 months? Is it the fact that actually there's a resolve in the West to stick together and the amount of weapons that were sent to Ukraine, or is it something else?
I think the perseverance of Ukraine and being able to adapt the society, the leadership by Zelensky, which nobody could have thought that he would be such a galvanizing, such a motivating figure, not just inside Ukraine, but also really rallying democracies for this. I think it is bringing that clarity. And to me, if we look at 12 months ago, what the consensus at NATO was, do we need to talk? Maybe we need to talk to Russia. Maybe we need to support Ukraine or not. There's no longer that exists. It's really that clarity that is in 10 months has been brought upon by this war and by actually Ukrainian support, Ukrainian perseverance, as well as Western unity, which yields that support that's needed. I think this is surprising if you tell me versus 10 months ago, but also a very welcome development.
Do you think this will hold? Will these coalitions hold? I know we're both going to Davos, and the theme is cooperating in a fragmented world. I mean, a lot of these themes are difficult to really understand. This one's quite clear. It's the West has to hold as a bloc.
It has to hold. That's right. But I think the two things is that NATO has made itself relevant. The European Union has made itself relevant. Now NATO has refound the mission. The Eastern Front is more stronger than ever before. The two new members are joining NATO. Fingers crossed by the middle of the year. I think we are in a good position. EU, the 9 rounds of sanctions. I think it shows that EU, which is such a fragmented organization, yet with such incredible legislative power, has delivered with the sanctions. It has offered Ukraine the membership plan, which is, again, it tells you that its leadership, the consensus is there, the support is there. Yes, on a ground level, there's all sorts of disagreement and how to do it tactically, operationally, but on a strategic level, I think we're very in a proper situation.
Should we take the threat from Vladimir Putin of nuclear war seriously? So what does that mean for NATO? Do they need to position their troops differently across the border?
I think it's important to take any threat serious. I think it's important. I think obviously it's a nuclear state, but we've seen it before. Russia, or before that, Soviet Union has always played the nuclear card in such a manner. I think the rhetoric that President Putin is now putting out is truly irresponsible, and I think the Secretary General of NATO has been very clear about it. I think President Biden and National Security Advisor Jake Sullivan have been clear. Anything that, if Russia chooses this path, it's very clear that it is suicidal for the regime, it's destructive for Russia. So, we have to take it seriously, but we also have to be clear-minded that this is not good for anybody, and for Russia as well.
What would happen after Putin? If there's, I don't know whether there is a belief and whether that's 5%, 6% of regime change in Russia.
I think it's hard to predict. There really at the moment, there are no opposition forces able probably to challenge President Putin. I think but at the end of the day, this fight for him in Ukraine is important, and he wants to deliver some sort of victory. And that's why I think for us, for the West, we need to stay on the message, stay on the path, support Ukraine, and see what happens. Really, the change in such a big country like Russia can only happen internally. And it's really up to the Russian people also to see what can be done, and how to move forward with this regime, or offer a new regime. Again, if the new regime comes into place through whatever means, through a method, it doesn't mean it's going to get better. It could be even more hardliners can step up. So, it's we have to do what we have to do, is support Ukraine, stay united, and I think as democracies we have a clear future for prosperity and peace.
Thank you so much for joining us. Jidremas Janklitskas, their non-resident senior fellow at the Atlantic Council, former of NATO. Now, coming up, more pressure on the U.S. presidents. That's as a probe widens into the classified documents found in Joe Biden's garage. That's coming up next, and this is Bloomberg.
do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Chinese exports fell by nearly 10% in dollar terms in December. That's as global demand continued to drop off. Now, Beijing is warning that foreign trade will still face pressures in 2023. Now, for more, we're joined by Bloomberg's Enda Kern in Hong Kong. Enda, good morning. Good afternoon, actually, for you. What are the key takeaways from this trade data?
Very weak trade numbers out of China, Francine, as you mentioned, almost down 10% in the month, speaking to the idea that the great merchandise trade boom, which was a pillar of China's economic growth throughout the pandemic, really has now come to something of an end. It's true that some of the disruption from COVID, the end of COVID zero and the lead up to that is probably part of this story as well, but nonetheless, it's a fairly soggy story. Chinese imports also weak, down 7.5%. That doesn't bode well for a regional demand, given how China's reliance on raw materials and resources from other countries. Nonetheless, though, these figures are a little bit backward-looking. Going forward, the story is meant to be about perhaps a global economy avoiding a worst-case scenario, and China itself, of course, getting back on its feet post-COVID zero. So the question becomes is whether or not this is the trough for China's trade slump or whether there's still a worse ahead.
So, Enda, switching gears a little bit, an arm of the Chinese government is also set to take shares in Alibaba and Tencent. What does this move by the government mean?
So they're taking small stints, I think, of around about 1% stakes in these companies, Alibaba and Tencent. Francine, on paper, of course, it speaks to the idea that the party is in control. It's all about influence. It's all about ensuring that they're at the top of these companies and having a say in where they're going, China's strategic interests. But though some analysts were making the point that these stakes are pretty small overall, and actually it does seem like the worst of China's tech regulatory crackdown is now behind the country, which is perhaps speaks well for maybe broader stability. We've certainly seen plenty of policy pivots in recent weeks. We, of course, have had moves to shore up the real estate sector. We had that dramatic move, obviously, on COVID zero. Now some people are saying that they think this is a signal that perhaps the tech crackdown is also nearing an end, that the government has come from to let these companies move on a bit. So I think the broader takeaway is, yes, of course, Chinese party exerting their influence, but some people saying perhaps the worst of that crackdown might now be over.
Enda, thank you so much. Enda Kern there with the very latest on China. He's in Hong Kong. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that prolific criminal hackers were behind a recent cyber attack on the UK's Royal Mail. A ransomware gang known as Lockbit targeted the company and used encryption to lock some of its computers, rendering them inoperable. The attack shut down the Royal Mail's ability to send international letters and also parcels. Now, Google and Nvidia are said to have expressed concerns to the US Federal Trade Commission about Microsoft's acquisition of video game publisher Activision Blizzard. Bloomberg sources say they have joined Sony in raising competition issues, adding fuel to the government's case against a $69 billion deal. Microsoft has said that Sony's concerns are self-serving. Shares in Uniqlo owner Fast Retailing fell the most in 8 months as COVID weighs on demand in the Chinese market. The Japanese company reported operating profits for the most recent 3 months that did miss estimates. It says it expects sales to return to normal by next month after Beijing's easing of pandemic restrictions. And Vodafone is reported to be planning to cut several hundred jobs, most of which are located at its headquarters here in London. According to the Financial Times, the mobile giant is making the move in an effort to rein in costs. About 9% of Vodafone's 104,000 staff are based here in the UK. And that's your Bloomberg Business Flash. Francine.
Yeah, thanks so much. Now, President Biden is facing greater political pressure after more classified White House documents were found at his private residence. Well, the discovery spurred Attorney General Merrick Garland to appoint a special counsel to investigate the incident. Now, for more on all of this, let's bring in Bloomberg's Bruce Einhorn. Bruce, good evening. What consequences could Biden face politically and legally as a result of this inquiry?
Well, with the appointment of the special counsel, there is now an investigator who has more leeway to go wherever he sees things going, right? The whole point of a special counsel is that they're outside of the sort of regular order of the Department of Justice. So it is a bit of a wild card. Attorney General Merrick Garland has appointed Robert Hur, who was a former official in the Trump administration's Department of Justice and then was the U.S. Attorney for the state of Maryland. There are a fair number of unanswered questions. How did these documents get there? What level of confidentiality are they? Why did it take so long for us to find out that these documents, which were originally found in November, why are we only finding out about it now?
Yeah, and are there parallels actually to what happened with President Trump, or is it just a different story?
Well, I mean, it's similar, of course, in that we're dealing with confidential documents that are in places where they're not supposed to be. So yes, there are definitely commonalities here. There are some significant differences, of course. We're talking about what seems to be a small number of documents. That's what the White House is saying, as opposed to quite a large number of documents that were found at Mar-a-Lago. The other big difference is that from what we've heard so far, when these documents were discovered, the Biden administration turned them over right away. That's a big difference from what former President Trump did. In some ways, the big problem that former President Trump has is not that he had the documents, is that what he did with them once the government asked for them to be returned. And so that's where the key difference is that in the case of former President Trump, he didn't return all the documents, and that then led to the special counsel in his case. So we have two different special counsels.
Bruce, thank you so much. Bruce Einhorn there with the very latest on the U.S. We will talk about this story, I feel, for a pretty long time. Coming up, stuck with risky debt, could Wall Street be facing the fallout of driving a flurry of mega deals during the cheap money era? We'll have plenty more on that next on our Big Take. This is Bloomberg.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's
doing
weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We got an inflation report exactly as we expected.
Very much in line with expectations.
Inflation has clearly peaked.
Inflation peaked.
Inflation is coming down.
But I think the Fed's going to say we're not done.
They will not be looking to pivot, or they won't be looking to slow down the rate hikes.
They're going to be really reluctant to, I would even argue, stop hiking, let alone start to cut rates.
The Fed has a clear path towards 25 basis points going forward.
Our call is 5.5 for that terminal rate.
But I think the narrative and the attention should turn to how far down are we going to go, not has inflation peaked.
Today is the day that inflation jumps the shark in terms of its importance on the market.
Some of our guests reacting to the latest inflation data from the U.S. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sam Bankman-Fried has used a blog post to deny stealing from his now bankrupt crypto exchange. The FTX founder offered one of his most detailed descriptions yet of the company's collapse as he prepares to fight fraud charges, blaming crashing markets and an attack from a rival exchange. The 30-year-old says he regrets being slow to respond to public mispreconceptions. The Chinese government is set to take so-called golden shares in units of tech giants Alibaba and also Tencent. According to a corporate database, Beijing bought 1% of an Alibaba digital media subsidiary. That was last month. The share structure could grant government officials influence over the industry, including the power to nominate directors. And the only child of Elvis Presley has died. Lisa Marie Presley had been rushed to a hospital in an LA suburb after suffering a cardiac arrest. She released 3 albums with a 2003 debut record selling hundreds of thousands of copies. She was 54 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, several major U.S. banks are due to report earnings today, but how many of them are stuck with billions of dollars of risky debt from M&A deals underwritten in the cheap money era? Now, for more on today's Big Take, we're joined by Bloomberg's Lisa Lee, who's one of the authors. Lisa, first of all, congratulations on a great piece. We pushed it on social media. You can also find it on, of course, the Bloomberg.com and the terminal. And it's basically the fact that this, leveraged debt machine is breaking down because of the current environment. So what exactly is causing the problem for banks?
So what happened is that they promised LBO financing early 2022, even late 2021, that they just haven't been able to sell because investors are asking for higher yield than what they thought they could get. So they sold as much as they could, but they're still left with about $40 billion. And now this $40 billion is not all concentrated equally. Some banks have more exposure than others. For example, Bank of America, which is reporting today, has some of the biggest exposures. JP Morgan has some of the smallest.
So was this mistakes? I mean, is it the change of environment, or was this, they took wrong bets?
Well, when you think about when they underwrote these, inflation was already high. The Fed was saying they were going to raise rates, but they leaned in. I don't think they thought inflation was going to be as persistent and as high as it was, or that the Federal Reserve would be as firm as it would to tighten it and rein in prices. So but some of them, like for instance, Twitter, which is 12.5 billion.
It's so surprising, right?
Yes,
I asked you what surprised you the most. Talk to me about Twitter.
So Twitter was inked after Ukraine, after inflation. There was a real thought that Musk could really turn around Twitter. And so that debt is sitting on banks' balance sheets, mostly on Morgan Stanley, Bank of America, and Barclays. And so we'll see how the banks account for that. But by our reasonable analysis and with reporting from the streets, there could be about $4 billion of losses mark to market. It was unrealized. They haven't sold it. That's a lot.
It's not something we can ignore.
No, we can't. Because that's $1 billion just for Morgan Stanley if that analysis holds. Now, it's really difficult to value Twitter debt. Because there's no other company sort of like it in the world right now, but they will have to account for it one way or the other.
Yes, and also, I guess hindsight is a beautiful thing, so maybe we're being too harsh on certain counts, but so who's been underwriting some of that? Is it, I know there's a story about JP Morgan and technology.
Yes, but that's, this is not, the technology one is not a debt story, so they purchased themselves a financial aid college online. And now it's not a very big purchase. 175 million is very small for JP Morgan. It's less than half of 1% of their earnings. But it just raises questions about their due diligence and their expansion into fintech.
Lisa, thank you so much, as always, for joining us. Lisa Lee there. Now, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Katie Lyons in New York, Anna Edwards in London. And I'll see you next week from Davos. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
The Fed knows that they have more work to do, and they'll do maybe, another few tightenings before it's over.
The Fed is going to have to maintain rates at high enough levels to make sure that inflation is moving down.
It just makes sense to steer more deliberately as we work to bring inflation down.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The UK may avoid a recession for now. Gross national product unexpectedly rose 0.1% in November. Apple CEO Tim Cook gets a huge pay cut, partly because of his own request. He'll still make $49 million this year. And big banks dominate today's earnings reports. We will hear from JP Morgan, Bank of America, Wells Fargo, and Citigroup. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee will certainly pivot towards focusing on the bank earnings story as we get through this program and as we get through this trading day. Yesterday, the CPI print, well, that was exciting for a little while, wasn't it? And the Fed comments, perhaps arguably outweighing the details in the data.
Yeah, the data, frankly, came in smack in line with estimates, so there was absolutely no surprise. Perhaps what may have been a bit more surprising was how quickly the rhetoric from the Fed seemed to have changed, kind of playing down the idea that they are going to continue at the same pace they have been for the duration of the last, say, year and change. That is something that Asian equity markets continued to weigh overnight. It broadly was an update. The MSCI Asia Pacific Index, actually, with a more than 1% rally today, is now at its highest level since June. And what is so interesting is you even saw gains among Chinese technology stocks, despite the fact that there was reports that China is looking to take so-called golden shares in the local units of Alibaba and Tencent, which would in theory give the government more control in that sector, but it actually may be being seen as a mild positive because those shares in both stocks rose overnight. Alibaba up about 1.7%, Tencent by 2%. We'll have more analysis on that story in just a couple of minutes. But outside of the equity market, in the bond market, what is fascinating to me is what is going on in Japan. Bond traders really seem to be pushing back against the BOJ, betting on the idea that the BOJ is going to have to assess the effects of its easy monetary policy and perhaps have to make a total U-turn on yield curve control, because we know the 10-year JGB yield is supposed to be capped at 50 basis points. We saw it climb as high as 57.5 basis points overnight. That prompted the BOJ to do a second day of unscheduled bond purchases, so we did come off the highs of the session, but still we're north of that 0.5 percentage point cap, Matt. Right now, the 10-year JGB yield trading at 51 basis points.
Yeah, watching that very closely as the BOJ continues to make unscheduled purchases, and I'm sure we'll talk about that throughout the program. S&P futures are unchanged this morning. We are going to get some more data later today, including the University of Michigan sentiment data that has occasionally proven to be market moving. The U.S. 10-year yield is rising a little bit, but it's still relatively low compared to where we've seen it the last few weeks and months. 344.67, the level on the 10-year. And then gold is relatively high. It continues its climb, now over 1,900 a troy ounce at 1904.91. So gold gaining just about 0.4%, but getting through that big round number of 1,900. And speaking of continuing to climb, Bitcoin is almost at $19,000 a piece right now, $18,922 where Bitcoin is trading, also up about 0.5% right now. So that march higher continues for the digital currency or commodity, Anna, depending on how you feel like defining it. What do you see in Europe?
Yes. Yeah, it feels like Bitcoin may be moving in tandem with European risk assets. That would be an odd one, but that's what we've got right now. This is European stocks up around 0.5%. So we're flat on US futures, looking to factor in a little bit of that post-CPI strength in US stocks, yesterday. Although, of course, European markets did have a chance to react to that yesterday. But it is that narrative that's been with us all week about the moderation in inflation that seems to be pushing European stocks higher. And I put the European stocks 600 in again, just to underline this point. We're up by 0.6% today. Another day of outperformance from European assets. And it is a fact now that we're heading towards the best performing, best start to the year, best 2-week start to the year for European assets, European stocks ever. So that does seem to be something of note and something we've talked about on this program a number of times. Not so for European autos, perhaps. That sector down by just over 2%. We've heard that Tesla is reducing the price of some of its vehicles in various markets globally. As a result, that increases the competition for the European automakers. The euro is pretty flat, but 108.46, so slowly making progress from that parity level that we talked about a lot last year. That was a time when we saw real strength in the dollar, of course. And this really tying in with some German data today. Might we not have seen contraction in the fourth quarter in the German economy? That's the question today. It looks more like it was stagnation, not contraction. I mean, stagnation isn't great, but it's better than contracting, given all the headwinds that were being thrown at the German economy, like finding entirely new sources of energy. And the pound at 122.36. We've had data out on the UK economy today as well, suggesting a better outcome for the UK in the fourth quarter than had been anticipated. The November data certainly points in that direction. It seems that the World Cup got people out of their homes and into pubs, and that obviously, in a very British fashion, seems to benefit the economy. Now, sticking with UK assets, earlier on Bloomberg, we spoke with Stephen Gallo, the head of European FX strategy at BMO Capital Markets. He explained why he's currently constructive on the pound.
But the optimistic case is that inflation moderates both in the UK and at the global level, stays moderate, volatility doesn't pick up substantially inflation, and the Bank of England is able to pivot, not necessarily cut rates by the end of 2023, but start taking a much more growth-friendly approach to how it sets policy. Now, if that's the case, despite the fact that it would mean the spectrum of sterling yields will drop, we actually think that's bullish for sterling. It's bullish for risk assets, it's bullish for UK assets, and it probably will support the pound.
Stephen Gallo with his view on the UK. Bloomberg's Valerie Titel has a closer look at some of the data we got from the UK today. Take us through it then, Valerie.
Yeah, so it's good news, Anna. The UK may not be in a recession, and it may not even fall into a contraction in the fourth quarter of 2022. This is now the second print in a row that's become above estimates. Today's print hit positive 0.1 versus expectations for a 0.2 decline. And it was driven mostly by the services sector, which, as we know, makes up a very large part of the UK economy. Nearly 80% of us here are employed in the services sector here in the UK. As you mentioned before, possibly because of all the spending at the pubs during the World Cup, that definitely helped this sector out. But if you look at what the ONS said about the fourth quarter, we probably need to see a 0.5% contraction in December in order to get a fourth quarter decline. That's unlikely to happen. We've had some good earnings releases from retailers here in the UK this week, especially Next, one of the biggest ones here in the UK, upgrading their profit forecast. It does seem like the consumer is holding up well here in the UK in December. But the bad news is the Bank of England themselves was forecasting a contraction in the fourth quarter, and if that doesn't come to fruition, possibly the labor market remains too tight and they might need to raise rates higher than expected. The 2023 GDP forecast is the BN survey estimate is nearly up for a 1% contraction in GDP growth, so the outlook still does look pretty nasty.
Well, Valerie, as we talk about labor markets that are still tight, the labor market is still looking very robust here in the U.S. as well, even as evidenced by the CPI data we got yesterday. We are seeing those inflationary pressures coming down. Is this all adding up to a greater likelihood that the Fed is actually going to be able to pull off the soft landing?
Hey, Kaylee, I'm becoming more and more positive every day that the Fed might be able to pull that off. But the data yesterday really came on the screws. Notably, the only thing running hot was the rent or the shelter components, which Powell has dismissed as a lagging indicator, so we're going to dismiss it too. If we look at these sectors on a 3-month annualized rate, they show substantial progress since the summer. I have here in yellow, this is services excluding shelter, and then core goods here in white. They've seen substantial declines since the summer, which points to the fact that the Fed's rate rises might already be making their impact on in the economy and reining in inflation. The market is currently pricing in 25 basis points of a hike for the Fed in their February meeting, and there's now a non-zero probability priced to the front end, Kaylee, that could be their last.
Oh, that changed pretty quickly. Valerie, thanks very much. Valerie Teitel there with a look at market expectations as well as the UK economy. Let's get to corporate news. A big pay cut in the works for Tim Cook. Apple is reducing its CEO's compensation by more than 40% to just $49 million this year. Bloomberg Quick Take's Alex Webb joins us now. Alex, how will he survive?
I know, my heart bleeds. Look, they've come under a lot of pressure from shareholder groups like ISS, which suggests that not only is he perhaps being paid too much, but too much of it is not, or I should say, not enough of it is tied to the share performance. There are two things happening here. The payment itself is decreasing, but a greater proportion of it, 75%, will be tied to the stock. And, you know, if we've seen Apple shares down 25% from their peak last year, you can see what's therefore driving some of this decision-making. Tim Cook perhaps also sending a bit of a signal to other executives about the direction of travel he thinks executive pay should go, because he is doing this voluntarily.
Okay, so that's an interesting one in the tech space. Good morning to you, Alex. Also in the tech space, the Chinese government is set to take so-called golden shares in units of a number of tech businesses in China, Alibaba and Tencent amongst them. Now, this is really interesting because just of late, we seem to have heard more conciliatory messages from the Beijing government towards big tech. So how do we read this?
Yes, it's sort of just saying we're going to give you, well, we saw in December that there was a big economic meeting which he signaled, as you suggest, a softening towards tech after the crackdown of the past 2 years or so. This is maybe just a note of caution that, like, yes, we're going to give you a slightly freer rein than maybe we have done of late, but we still want to keep you within arm's reach and keep you in check. There have been certain crackdowns, not least on some of the leadership within those companies. So having the golden share means the government has a seat at the table when it comes to how these companies are administered.
All right, Alex, thanks so much for joining us. Bloomberg Quick Takes Alex Webb there talking to us about Apple. Another bank's earnings season is upon us. JP Morgan, Bank America, Citi, and Wells Fargo will all step up to the plate and then some. Sonali Basak, our global finance correspondent, joins us now for what we can expect later this morning. Sonali?
There are a few things. There's some really bad news. Of course, we know the investment banks are expected to be down 50% or more. 4 banks reporting today, including JP Morgan, where those investment banking results are still a very, very big number. Now, trading, on the other hand, remember, some businesses had their best quarters or second best quarters. Rates across the industry were just blowing through the roof. Bank of America has already said that they could have the highest fourth quarter ever when it comes to trading. But there were also some hiccups, remember, in the quarter. Think about $70 million lost at a European high-yield trading desk over at JP Morgan. So some idiosyncratic events to watch out for in terms of how it would affect performance and the numbers at the end of the day. The other thing with JP Morgan in particular is that net interest income could mint another record. But if you look forward, do they still feel those benefits from high rates? At the end of last year, we heard an executive tell an audience at Goldman's Financial Services Conference that certain businesses, mortgages are still going to be under pressure next year. Card could start to moderate. And so do they still get that benefit from net interest income moving forward when we already know that in the fourth quarter, they're probably going to come in a little bit above expectations on net interest income as well as above expectations on expenses. So some good news expected for JP Morgan. Can that follow through into 2023?
Okay, so trading could be okay. M&A, though, looking more challenged, Sonali. What about the very consumer-facing parts of the banking system? I mean, you've mentioned net interest margin and the sort of bread and butter of banking. A resilience of the U.S. consumer, that could be a feature of what we see here.
It certainly will be, and in some ways you'll see it in terms of potential loan growth moving forward. But I think you also really have to keep an eye out here for the provisioning and how much more it could expand into this year. Of course, provisioning happens every quarter, and as things change, change and deteriorate there are more added throughout the year. So the expectations are expansions and revisions there. I would also say, how do you grow the businesses? Remember, very recently reported on JP Morgan the issues they've had with the recent acquisition, which was, again, a very, very, very small acquisition when you look at the entire asset base over at JP Morgan. But the idea here being is the way they expanded was this technology acquisition that had questions around the diligence at the end of the day that amounted to lawsuits. Separately, we're looking at Goldman and potential releases here of restatement of earnings before their investor day that is coming up, as well as their earnings that come up next week. And so the consumer business and how they've expanded there and how they continue to mold that business will be a key thing to watch even today, Anna.
All right, Bloomberg Sonali Bosick, thank you so much. And we're going to get more analysis on the banks later on this hour with Allison Williams, Bloomberg Intelligence Senior Global Banks Analyst. Now, another story we have to watch today, more bad news in the world of digital assets. Crypto.com says it has laid off about 20% of its global workforce. That's on top of layoffs in the middle of last year. Plus, U.S. regulators are now suing crypto brokerages Genesis and Gemini for breaking securities rules. This is in regard to the Earn product. So, Matt, you already have Genesis and Gemini, or at least their respective founders, the Winklevoss twins and Barry Silbert, going head-to-head over this issue. Now enter the regulators as well.
Yeah, absolutely. And I think it's interesting that the regulators, that the SEC is suing both Genesis and Gemini together for the Earn program because they work together. They couldn't have functioned without each other. So it's both Cameron Winklevoss and Barry Silbert that are going to be dragged into this lawsuit. And the question is, if the SEC is successful here, do they start to go after other crypto lenders? Because this is something that other companies had been doing, not just these two. It's just that these two were the ones that put down the gates on withdrawals.
Yeah, so what kind of precedent is this going to set? Of course, this is going to be a story we continue to cover each and every Tuesday on Bloomberg Crypto. That's at 1 p.m. New York time, 6 p.m. in London with Matt and I. Now, on the subject of crypto, I do want to point out in pre-market trading today, even though you are seeing Bitcoin prices actually a little bit higher, some crypto stocks are under pressure. Coinbase is down 1.5%, Marathon Digital down by about 1.3%. One stock that continues to rally, though, is Bed Bath & Beyond. Already in the first 4 days of this week, it is up 300% on the week, and those gains are continuing today. That stock up 6% in early hours after reports that it's speaking with potential lenders that would finance the company during bankruptcy, and that could actually result in the sale of some assets. And then finally, I have to point out Tesla as well. This is a very big story this morning, Anna. The stock down about 4.25% after it says it's going to cut prices across its lineup in the U.S. and some other major European markets, including Germany, France, and the UK. It really underscores the demand issues that Tesla is facing, and they're trying to do more discounting to try to bring that demand back up. The stock, though, heading down this morning, Anna.
Yeah, and that sector, autos here in Europe, by far and away the worst performer in today's session, down by just over 2%, as that very story, Kaylee, weighs on sentiment here. When we come back, we'll talk to Kamakshia Trivedi, Goldman Sachs head of global foreign exchange, interest rates, and emerging market strategy. A great person to talk to about a host of themes: the Eurozone growth story, the UK growth story, the BOJ, and what we expect from next week. All of that will be in focus. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You got to think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kaylee Lyons here in New York. She's back, and Anna Edwards out in London. We are looking at economies that possibly avoided contraction. I know that the German economy, Europe's largest, avoided a contraction, but we'll breeze right by that because we love the UK much more. It also looks to have avoided a contraction in the fourth quarter. And the FTSE has been on absolute fire over the last year compared to most of the other major indexes in the Western world fell. This is a chart that Dan Curtis, our charts producer, put together for us, showing that a large part of the FTSE's gain is down to the currency. For those of you listening in radio, we're looking at a gain in pounds. That's the white line here. But if you look at it in euros, which is the blue line, or dollars, which is the yellow line, it hasn't done nearly as well. Joining us now is Lynn Thomason, Bloomberg Markets editor. And Lynn, this goes back to Brexit, but it just shows that it's better for domestic shareholders than it has been for those out of the UK.
Yeah, absolutely. I mean, I think if you're a dollar-based investor, you're facing that headwind of the weak dollar eating into your returns. But certainly, UK investors will like this very much.
Yes, indeed. And European assets more broadly, to Matt's point, let's broaden it, Lynn, from the UK. We can do that and talk about what's going on in European assets broadly, because actually European stocks as a whole have had their best start to any year ever, if you take the first 2 weeks of this year.
Absolutely. I mean, it's so amazing. I can't think of the last time in my career that people were excited about buying Europe. And it speaks to the broader trend of the US and all those big hot tech shares coming off and people looking, for what to do with their money. And I think all of a sudden boring is beautiful. Europe has lots of, big commodity companies, drug makers that are taking that cash.
Well, and Lynn, Europe is also having better weather than was expected.
Yeah, I think the fact that the gas crisis hasn't been as bad as we all expected is by far the biggest, spark that's driven this rally, and I think adds to this narrative that Europe and the UK is a great place for investors right now.
I mean, it's not just stocks. Stocks has been a focus of our conversations, but also the euro slowly, steadily gaining ground behind the scenes. 108 now. Amazing,
and the pound as well, back to $1.22, and you're also seeing more companies come to market. There's been an absolute explosion in bond sales. So again, I think Europe is really becoming a big focal point.
Yeah, absolutely. Explosion in corporate and sovereign debt sales here in Europe over the past week. Thanks to Lynn Thomason for joining us with a look at the markets. For more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. President Biden's handling of classified documents erupted into a political crisis with potential legal repercussions. A special counsel has been named to investigate. Meanwhile, the White House has confirmed that a second set of documents was found in a garage storage area in the president's home in Delaware. Bloomberg has learned that more fuel has been added to the U.S. government's case against Microsoft's $69 billion takeover of game maker Activision Blizzard. Alphabet's Google and NVIDIA have joined Sony in raising issues with the transaction. The FTC has sued to block the deal. In Alabama and Georgia, violent weather killed at least 7 people. Much of the damage took place in Alabama, where a tornado cut a 20-mile path across 2 rural communities. 6 people were killed and more than 36 homes were damaged or destroyed. And the only child of Elvis Presley has died. Lisa Marie Presley had been rushed to a hospital in Los Angeles on Thursday after suffering a cardiac arrest. She was a singer who earlier this week appeared at Graceland, the mansion where Elvis lived in Memphis, Tennessee. Lisa Marie Presley was 54.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The UK may avoid a recession for now. Gross national product unexpectedly rose 0.1% in November. Tesla is slashing prices in the US and major European markets to try to reverse a sales slump. The electric car maker cut the cost of its cheapest Model Y by 20%. And big banks dominate today's earnings reports. We will hear from JP Morgan, Bank of America, Wells Fargo, and Citigroup. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, the focus clearly is going to be on all the earnings out of the banking sector a little bit later on today. We'll see whether US equity markets have further to rally on those dovish expectations that led us quite far, actually, in terms of risk assets in anticipation of the CPI report, which, of course, we got yesterday.
Yeah, and as Kaylee points out, it was bang on, and as a result, we had, well, the market didn't really know what to do with that yesterday. I think a lot of people were anticipating a better than expected CPI report. And so initially we fell, and then later we rose. I think we closed around 39.85 or so on the cash trade on the S&P. So just under 4,000. As you can see, futures are right there right now, 4,003. Not a whole lot of movement. We're getting some more data out later today. And of course, the big bank earnings are so important to this market to see if we have lowered the bar enough to beat this quarter. I'm sure we have. U.S. 10-year yields at 345 right now, unchanged, but at a really low level relative to what we've seen the last few weeks. That's good news for risk assets. And then gold, back up over $1,900 a troy ounce. It's not a huge move, only 0.4%, but it's a big round number. And I think it'll get a lot of people's attention. Gold has been in a pretty steady rally mode for the past few months and continues to gain as expectations for the Fed to raise rates slow down a little bit. And indeed, yesterday we had the third Fed speaker in as many days coming out and saying 25 basis points is cool for now. That may indicate what they're going to do on February 1st. So no longer expecting 50, and the market's no longer pricing that. Finally, Bitcoin up over $18,900. It has been on a tear this week after being stuck at 16,000 and change for well over a month. So finally a move to the upside, but it's not really helping in terms of the pre-market movers, Kaylee, is it?
Yeah, no, it's not. You're seeing some crypto-related equities actually under pressure today. Also under pressure, Matt, your other favorite subject, automakers, and this really has everything to do with the Tesla story that Anna mentioned, cutting prices by 20% in the US and major European markets, really trying to stimulate demand, which has been lagging as of late, and that is dragging down the stock. It's down about 4% in early hours, and that is also bringing other auto stocks down in sympathy. General Motors, Ford, each down about 2.2% or so, as is other EV makers. The likes of Lucid Group and Rivian are under pressure too. Rivian right now down by about 2.25%. So autos across the board in the US are lower, Anna, and I know that is also true in the European session.
Yeah, absolutely. It's interesting how this is a story that's being seen as good for nobody in the auto space, and that certainly is true here. This is auto stocks down by 1.9%, by far and away the worst performing, one of the only negative sectors here in Europe today, and it seems, entirely to do with that Tesla story. If they are more keenly priced, then perhaps that increases the competition for, in particular, the luxury end of the market here in Europe. This is the broader European story, though, which looks different, looks positive, up by 0.6%, and in fact, we've seen the best start to any year for European stocks. So the past 2 weeks have been really strong for European equities, and we know the reasons for some of that. It's for that reason that we've been watching the German data as well. We've got the euro at 108.44. I put that in just to reflect on the German data that we had out today. It looks as if we didn't get contraction in the fourth quarter in Germany, which is an incredible achievement when you think about the headwinds being thrown at that economy to do with trying to find new energy sources and all of the things that go along with that. So if they manage to just quote unquote stagnate in Germany rather than see some kind of contraction, that's being taken perhaps by some in the market as a positive sign. The pound is at 122.33. As we mentioned in our headlines, maybe the UK economy didn't contract last quarter either. We got the month of November data for GDP out of the UK, and just like October, that came in better than had been anticipated, and so really raises the spectre of perhaps going into the winter, at least here in Europe, in a better place than many had anticipated, Kaylee.
Yeah, so it's interesting to see that maybe the economic damage won't be as severe as anticipated in Europe, in the UK, and potentially here in the US as well, given the data we continually get out that shows inflationary pressures are easing at the same time that the labor market is still hanging in there. So let's discuss that further. Joining us now is Kamaksha Trivedi. He's Goldman Sachs Head of Global Foreign Exchange, Interest Rates, and Emerging Markets Strategy. Kamaksha, for you, have the odds of a soft landing improved materially in recent weeks?
I think they have, absolutely. I think you mentioned some of the data. I think we are making progress on the inflation front. You know, you're seeing that in the price data that we got yesterday, but also more importantly, the revisions to the wage data that we got out of the payrolls report in the US were pretty encouraging. So I think that the odds of a soft landing in the US have gone up. At the same time as we've had some pretty positive growth surprises in the rest of the world. You flagged the fact that Europe is doing, better after the milder winter that we seem to be having, and China's reopening occurring much faster than I think many people expected. I think is also going to be a positive demand shock to the rest of the world. So all in all, yes, it's been a more a combination of news that is, I think, more constructive for global risk sentiment over the past month.
And what does that tell us about where the economy goes then, Kamaksha? Because if we get growth that slows less than expected, if we have a more resilient picture, does that mean that rates stay higher for longer and applies a different kind of headwind?
I think that's correct, although I think the leadership of where the rate pressure comes from might shift. If you think about most of last year, a lot of that came from the US. I think in the near term, the fact that Europe might actually be doing somewhat better, and the ECB has sort of taken on the baton of being the more hawkish central bank, might mean that you get more hawkish impulses to global rates coming out of places like Europe, like China, where growth will swing up, and potentially like Japan, where you're seeing the Bank of Japan make some surprise tweaks as well. So yes, I think it's still going to push rates higher, but I think the bearish impulse is going to be in the rest of the world compared to the US.
One of the topics of conversation being thrown around on the Markets Live blog, Kamaksha, today is around, linked to what you were just saying about where the hawkish impulse comes from, is whether we see Eurozone bonds or Treasuries doing better in 2023. Which do you think?
Look, I think that in the first part of the year, I think certainly treasuries look more interesting. I think they also look more interesting because, while I think the odds of a soft landing have gone up, I think that recession risks are still probably higher than normal. And in a portfolio context, the hedging value of bonds is certainly sort of better. And so I think in the first part of the year, I think treasuries look better. I think as we go through the year, I think the resilience of the U.S. growth picture is going to come through much more clearly. We don't think the cuts that are priced into the curve in the second half of the year are going to be delivered, but you probably need to get closer to that point with positive growth for the market to relent on that cut pricing. That's the point at which the Treasury yields might start to move up again.
What do you think we're going to see in terms of economic growth this year? We've, it looks like, avoided a recession, at least in Germany and the UK in the fourth quarter. Do they go into a recession, the continent and the island nation in 2023?
Look, I think the picture in Europe looks definitely more encouraging, even relative to a month ago. I mean, think of it almost like a positive supply shock. It's not like Europe has discovered new gas, but relative to expectations and relative to seasonal considerations, Europe is coming out of this winter with, higher gas storage and a better growth and inflation mix than elsewhere. I think the additional complication in the UK, which is why we would still be somewhat, more concerned about the UK, is that the increase in mortgage rates has a much bigger impact on disposable income, on consumption in the UK, just given the structure of the housing finance markets in the UK relative to the continent and also relative to the US. And so I think there are still some differences there. We'd be more cautious on the UK. We'd be more cautious on the pound, even from these current levels, relative to the continent, where, we do think that both the momentum of the data, but also the developments that we've learned over this winter actually are quite encouraging.
Is there any concern, Kamaksha, that central banks, and I'm thinking really specifically of the Fed right now, but I suppose it could happen anywhere eventually, slow down too soon? If the Fed just goes 25 February 1st and maybe another 25 or nothing else after that, then we get inflation roaring back and Jerome Powell ends up looking like Arthur Burns. Is that a concern?
Look, I think that given the moderation in inflation and, some of those, occurring at the headline level, but also some of the positive developments at the wage level, a step down in the pace of hikes and the lower rate volatility that we are seeing is probably appropriate. It's still going to be a hard battle to get core inflation down over the course of the year. And, the central banks have been messaging that rate cuts are going to stay, rates are going to stay higher for longer. The market doesn't quite buy that right now because there is a lot of concern around recession risk. But if, as you say, we don't see that recession, we see the resilience in the economy and core inflation stays sticky, I think you're going to see financial conditions tighten just by taking out of those rate cuts that are in the second half of the year. But I think that is a discussion for later. I think it's fair to say that the growth inflation picture we've got right now is actually pretty constructive and means a slightly longer runway for this constructive price action than we had thought previously.
Kamaksha, if we could just end with one central bank that has kept policy easy, that's the Bank of Japan. We have seen the slight tweak to yield curve control. The market really seems to be pushing the resolve of Kuroda and his team to tweak that further, considering we have seen the 10-year JGB yield breaking above that 50 basis point cap. What is your expectation of what happens there?
Look, I think that, the fact that they have moved, I think has certainly opened up a wider range of possibilities. And I think many investors expect that there will be further moves, next week itself. I also think that the fact that given their move and given the move in Japanese rates that you mentioned, in fact, Japanese swap rates have moved even further, anticipating further increases in and tweaks to the yield curve control framework. The fact that you haven't seen big spillovers from that to the rest of the world, to other global rates markets, it probably gives them some comfort that if they did want to get away from that sort of policy setting, this is probably not the worst time to do it compared to last year when, global core rates were moving much higher, much more rapidly. So I think there's a decent chance that we see more tweaks to their policy framework in the upcoming months.
Okay, Kamaksha, thank you very much. Kamaksha Trivedi of Goldman Sachs, thanks very much for bringing us your views on global markets. Coming up, we'll get to the earnings season. Earnings from JP Morgan, Citi and Wells Fargo are due later today. Lots of banks reporting next week as well. We'll get a preview of what to expect. Plus, one question for bank executives will be how they are managing the build-up of leveraged financing. Today's big story takes a look at how Wall Street's leveraged debt machine is breaking down. It was built up in the era of cheap money. How is it weighing on M&A deals now? Look for that on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. It's a big day for banks as JP Morgan, Bank of America, Citi, and Wells Fargo kick off Wall Street's earnings season. Fourth quarter results may be overshadowed by the threat of a downturn. Joining us now is Allison Williams, Bloomberg Intelligence Senior Banks Analyst. So, Allison, thanks for getting up early and coming to the studio with us. What's your expectation broadly? I mean, I feel like we've already seen loan loss provisions raised, and the dour mood has kind of turned around a little bit.
So we do think that the banks are going to add to reserves. The recession is the question of the year, but you're not going to see it this quarter. What you're going to see is very strong net interest income growth. I think that continues to be the story. Fees are weak. That's sort of well advertised. Provisions. So the banks will be taking reserves partially due to the weaker economic outlook, but also because of loan growth. We expect credit card to be strong. It's a seasonally strong quarter. The big news that we could get today is related to costs, and that's because there's an element of management judgment there. We know that there's broad cost pressure, but also how much are the banks investing? Hopefully they continue to invest for the long term, but that tends to be the surprise that we get in January. That's the surprise we got last year with a much bigger budget from JP Morgan. This year, we think that that pace of investment might be slowing, but there still are cost pressures.
Well, and that's why we've seen banks like Goldman Sachs doing pretty large cuts in terms of their workforce. I wonder how much of that is going to be in that investment banking side, considering the IPO and deal-making pipeline has been so weak. Is that going to be the story as we look forward to the rest of this year?
I think that could be a story, closer to mid-year. We are going to see cuts at Goldman Sachs, 7%, according to the numbers that we've seen from Bloomberg News. But there's a few unique things going on there. So about 2/3 of those really are outside of the core investment banking and trading business. They've had this consumer strategy. They're pivoting that strategy. They're going to reorganize the business. We expect that we'll hear more details about that at their upcoming Investor Day. But we think for the most part, banks are not going to be making big cuts to investment banking. The pipelines have stayed full, despite the fact that deal activity was down significantly. We think equity fees are down 70% this quarter. Fees are probably half of what they were in 2021. Granted, 2021 was a record for IPOs. But we do think that the investment banks are a little bit hesitant to cut because in mid-2021, when things were so strong, they were scrambling to find bankers. And so where you might see more of an adjustment is the compensation line.
Okay, yes, we certainly saw that war for talent being such a dominant theme a year ago or so, didn't we, Alison? What about, you've referenced some of the themes in investment banking there. What about trading more broadly? You talked about equities and the IPO market, but what about the trading side, maybe in fixed income? Where are we possibly going to see some bright spots?
Fixed income, we expect to be very strong. We think that there's going to be growth of probably 20% compared to a year ago. And we will be looking across some of the competitors. Goldman Sachs and Morgan Stanley, who report next week, we think could have some of the stronger results, but certainly we'll get a read today. JP Morgan and Citigroup, as well as Bank of America, very strong in that business. Wells Fargo growing. So FICC up 20%, equities closer to flattish. Keep in mind that equities has a tougher comparison to strength a year ago. And within fixed income trading, we're looking for a continuation of the strength in the interest rates business. Also emerging markets, Jefferies had a 70% jump in their business. A lot of that was aided by the emerging market strength.
You mentioned the compensation line. I'm sure a lot of bankers watching are wondering if they don't know already what their bonus is going to look like. Will we get in the earnings reports some kind of foreshadowing of that?
I think we'll have a look. It's not going to be as clean of a look as we'll see next week with Morgan Stanley and Goldman Sachs because the banks today are more diversified. We will look to JP Morgan's corporate investment banking unit to see what the trends there are in terms of compensation. Its revenue is down, so you would expect compensation to be down, but we do think that the cost to compete has not come down as much as you would have thought, given the 50% drop in investment banking fees. It still is competitive out there, and so we're going to be looking for compensation to come down, but we're going to be comparing that to see how that ebbs versus revenue.
All right, a lot to keep track of with the 4 big banks reporting today. So thank you for joining us early on a busy day for you. Allison Williams of Bloomberg Intelligence, we appreciate your time. And coming up later today, we'll be hearing from one of these big bank executives. The CEO of Wells Fargo will be joining Bloomberg Television. That's at 4:30 p.m. in New York. CFO. Thank you, Matt. 9:30 p.m. in London. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York, Anna Edwards with us out of London. The whole band is back together, which is exciting, an exciting way to end the week. Let's also, another exciting story, certainly for consumers, not as much for shareholders. Tesla is slashing prices in the U.S. and major European markets as well after several quarters of disappointing deliveries. The move is dragging down the stock in pre-market trading. Bloomberg's global autos editor, Craig Trudell, joins us now. So, Craig, we saw already big price cuts in China. A lot of people were wondering if that was region-specific, but now we're seeing huge lops off of the tag in the U.S. as well as, well, at least Germany and the U.K. too, right?
Yeah, France as well. It's really looking, more or less like Europe-wide. So, and to your point, Matt, these are not just little trims. These are big reductions. We're talking about 20% for the Model Y, which is their top model globally. For the Model S and X Plaid, you're seeing huge decreases and other iterations of those vehicles as well. So some of this can be chalked up, of course, to wanting to get their vehicles eligible for tax credits in the U.S. But it's not only that, right? This applies to markets where there aren't any changes in incentives from governments, and it applies to models that even after these pretty significant price cuts, they're way above the limits.
What does it mean for rival car producers then, Craig? I was looking at a breakdown of European stocks today, and autos stands out as by far and away the worst performing sector today. This is really weighing on the sector.
Yeah, I mean, I think we're definitely still in a position of more demand than the industry can meet for electric vehicles, but this doesn't necessarily inspire a ton of confidence about being able to sustain the pricing power that this industry has been able to over the last year plus. And I think we do have to sort of acknowledge that the last couple of years have been not at all normal, right? These are companies that are really production constrained. The chip shortage has been a significant issue, and so we've seen waiting lists for EVs and combustion vehicles as well for some time now.
Just finally, Craig, very quickly, are we going to see more board pressure on Elon Musk, the man himself?
I think we're already hearing a fair amount of that and seeing a fair amount of that, even with shareholders that are big fans of Musk. They want to see more out of Tesla in terms of what's the bench like and what the succession plan is going forward after the events of the last few months where he's, moved his attention away to Twitter.
Moved his attention, maybe got a little bit distracted. Craig, thank you very much. Bloomberg's Craig Trudell joining us there with latest on the auto sector. That is it for Early Edition. Surveillance is up next. They'll be hearing from Gerard Cassidy, U.S. Bank Equity Strategy Head at RBC Capital Markets. Of course, we're homing in on the U.S. bank earnings. We will get plenty of U.S. banks reporting today. J.P. Morgan, Bank of America, Wells Fargo and Citi all report today. Next week, Morgan Stanley and Goldman Sachs. So we'll learn a lot about the U.S. banking sector over the next few days. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close.
Welcome to Bloomberg Crypto.
This whole episode will turn out to be transitory, but the reason why it's transitory is because the Fed reacted.
The Fed is a risk manager. I think they need to stop. This is a war that they've won, and they're in danger of tipping the economy into recession. I think they're making the fiscal problem worse.
It's the prevailing view now, and I think it's right, that we're heading lower in inflation, and we've seen a peak.
Inflation has a number of parts to it. John Williams talks about the inflation onion. We've gotten the good news on the outer shells.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Earnings season begins right now, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Equity futures down about 0.1% on the S&P this hour. Looking to hear from Bank of America in the next couple of hours, from Goldman, perhaps a little bit later next week, Tom, and then JP Morgan later this morning as well. TK, can you keep up?
Well, yeah, I could keep up. Why? You think I'm not here? Happy Friday to you, too. No, the answer is, yeah, I think it's going to be interesting to see. It's always interesting, but ever more so with what we've seen on the inflation dynamic, how the banks deal with that, how it does with their traditional banking, and also what they do. And the answer is they're going to do exactly one thing. Here in Davos and after Davos, they're going to cut costs.
The recession talk, Tom. Tesla, should we start there? 20%.
They got like 8 ways to start today. It's a busy Friday, folks.
Right there. Yeah. 20% price cut, US and in Europe.
Dick Berner was a giant at Morgan Stanley, and we once had dinner, and he and I walked through what fixed costs and variable costs do to a company. I would suggest an automobile company, whether it's run out of a Twitter headquarters or not, is a massively fixed cost business. When you cut 20% in pricing, revenue is unit in pricing, you need a real unit makeup to cover any of your marginal fixed cost change.
Where does that volume come from? China reopening, Europe?
Is it that, or is it the new competition in EVs? You know, I sit there and I watch the EVs of New York City drive by, and not all of them are Teslas.
Have you seen the performance of the airlines so far year to date?
Yeah.
I went through the numbers overnight, Tom. United up 36%. This is 8 trading days. American up 32, JetBlue up 25, Delta up 20.5%. These are major gains.
And one of our guests said, is there a huge repositioning going on? And the repositioning is not only there in equities, and we'll talk a lot about that today, red and green on the screen, but also in foreign exchange. People here that are not focused on the nuances of 20 or 30 different pairs, which you can do in the Bloomberg, there's some real tangible movement I did not expect in foreign exchange.
Well, let's talk about it. Dollar's collapsing. Can we be clear about that? The dollar peak at the end of September, down by more than 10% since then. The yen is stronger again this morning. We've had dollar yen go from 150 to sub 130. We've had cable go from 103.50 through 120. And euro dollar, Tom, we were talking about 95. Now we're staring down the barrel of 110.
Yeah, let's dive into this now because we got a bank extravaganza coming up. For Global Wall Street this morning, folks, a linkage here of economics and finance trying to get out front of 2023, and I'm going to use this word respectfully, is the unraveling of Japan. I went back and looked. I did a very careful regression study of YCC, yield curve control. And they're not out 3 or 4 standard deviations, John. My mathematics is they're out over 6 standard deviations off the hope and prayer of yield curve control 2 years ago. The yield has come up. It's breached through their collar, if you will, and you see it in weak and strong yen.
Does that get dropped next week? That's a massive question for us. Going into that BOJ meeting, the threshold 50 basis points, to TK's point, went through it in the last trading day. Let's get you some price action. Equity futures on the S&P 500 look a little something like this. We're negative not even 1/10%. Looking for numbers from JP Morgan and from Bank of America a little bit later this morning. Yield to higher by a single basis point. Your 10-year 345.22. Euro dollar 108.39. Euro dollar right now negative 0.1%. Joining us now is Katrina Dudley, portfolio manager and research analyst at Franklin Mutual Services. Can we get straight to you, Katrina, on just what you expect from the bank earnings a little bit later this morning?
Look, I think what we're looking for the bank earnings is really that arbiter of whether or not we're going into a recession, because I think they're going to be the first line of defense here and the first people to see it. So we're looking closely at JP Morgan when it comes out and to see what Jamie has to say about where we are in the economic cycle.
Yeah, I look, Katrina, at the economic cycle, and I would suggest in 9 days has changed. And for a portfolio manager, with all the sell-side advice you've got, your internal wonderful advisors at Franklin Mutual, have you, not radically adjusted, but is there a change agent within a given portfolio because we've gone from December 20th to what we hope will be January 20th?
We're a value manager, so we do not make those very, very significant shifts in the portfolio.
You're not shifting, Katrina, you're not shifting on the inflation dynamic now as a value manager.
No, in terms of the inflation, we continue to see the Fed working and bringing it down. The question is, and that's the question we've been talking about all over 2022, is whether or not the Fed engineers too much of a recession or whether or not they walk that tightrope of slowing down the economy to slow down inflation without tipping us into a deep recession. We've continued to be of the position that if we do go into a recession, it will be a mild one. And I think we're seeing all the signs of a very mild recession. And that has very good implications for companies because it's manageable. A deep recession is really difficult to manage. As you talk about that fixed versus variable cost curve, we think a mild recession, companies can muddle through.
So on a value basis, which sectors do you find the best dynamics to surprise into, say, June or July?
In terms of surprise, one area we're looking at is the industrial sector. I think that when we're talking about industrials, we're not talking about as much the autos that you're talking about with Tesla, and we are aware of what happened there yesterday or this morning. We are now looking at industrial companies well-placed, and they have this really good secular theme that we're focused on. It's the electrification, it's Industry 4.0, it's the Inflation Reduction Act. Those things will be structural drivers, and we're just making sure that these companies have enough wherewithal through 2023. We think the order books are very, very strong. The backlogs are at very high levels. And we think that the variable costs, so rising wages and any other type of inflation, is really manageable. These industrial companies are areas that we like.
Katrina, where do the miners fit into this? We caught up with a guest a little bit earlier this week, Chris Verona, Strategas. Rio, absolutely ripping. He liked Rio, BHP, Glencore. Where are you guys on those names?
We do own a position in Rio, and we disclose that, and we like the asset quality that we have there. But you're right; those type of names have gone up substantially, which makes the valuation case a lot harder than it was just a few months ago. But as a value manager, we're looking at where are they positioned in the commodity complex, and we're trying to make sure that we've got that really good combination of companies that, while they are dependent on commodity prices, they have a lot of things that they can do internally that will drive earnings in addition to realizing the benefits of the commodity cost moves both up and down.
Katrina, can you just go a little bit further there? You said it's important where they are exposed in the commodity complex. Where do you want them exposed and where do you want them not exposed?
I think that we can look at something like the copper market, which people are very much structurally bullish on. We're seeing some signs that actually that's coming into balance. And what does that mean is you're likely to have some level of pressure on prices, but balance is okay. It's when we have oversupply that we need to be cautious about. So they're the type of markets that you want to avoid. And so from our perspective, we just push them to the side and we focus on those type of commodities where we have the either iron ore exposure and we have copper exposure and various metals where we're very comfortable with that supply-demand dynamic.
Well, Rio has that, that's for sure. Katrina, thank you. Katrina Dudley there, Franklin Mutual Series. Looking ahead to the earnings later this hour and over the next week as well. Let's get straight to Shanali Bassett, Tom, just on a headline that crossed the Bloomberg just moments ago from Goldman. Shanali, good morning. That was unexpected.
We've expected them to restate earnings here for the last 9 months, the first 9 months of 2022. And it's because they're reorganizing these businesses and they're going to report earnings on Tuesday. We have some details now of that reorganization, what it looks like inside. And you have a $1.2 billion loss here for that platform solutions business where the consumer businesses are rolled into. Now, over 2 years, really, from the beginning of 2021 through the first 9 months of last year, you have $2.2 billion lost in that business. Now, that gives you a lot of context into how things are going there during this reorganization as he pivots what he was trying to do with the consumer. Because remember, out of the new business lines that have been announced, it is really the only money-losing business over at Goldman Sachs.
Goldman reporting next week. We get Bank of America and JP Morgan this morning. Whole host of banks today, all at once. Shanali, what are you looking for?
Well, one of the things, even at Goldman, a lot of those losses are coming from provisioning for loan losses as well, in addition to expenses. So when we look over at JP Morgan, $2 billion are expected in provisions. Does that start to worsen throughout the year? We already know they're going to beat on net interest income relative to their initial guidance, similar for expenses, but they've already said that cards are going to start to moderate. Mortgages are still under pressure. So consumer businesses, remember, last year did much worse than the investment banks, which is not always typical for what you see in an environment like this. You were talking about rates earlier, Tom. That is a huge boon for the banks. They've made a lot of money. They're going to keep making more money.
I look at this, folks, and this is what's called an 8K. And the answer is it's a nothing burger except for one single block of data. And that is with this clownish phrase. What is platform systems? What is solutions?
You're going to take
what
that
is
up with David
platform?
Solomon?
It sounds like McKinsey made it up at a cocktail party at Davos. What is platform solutions?
Platform solutions is where a lot of these direct-to-consumer businesses are going into, as well as this other business, which is now much smaller, transaction banking.
This is one of the worst paragraphs I've ever seen. The rest of it's a complete nothing burger. It's just a bunch of McKinsey management change stuff. Is Mr. Solomon's job at risk?
It's year 5. It's hard to say.
I'm looking at a vector trend here. There's no ebb. I mean, just in one, provision for credit losses was just one line item. 167, 310, 465. The trends are going the wrong way on this one paragraph in the 8K.
Let me set up the stakes for him for a minute here, because you have his investor day at the end of February. I think that's when the heat really starts to get on him. Once you get to next week, a few things to ask yourself on Tuesday. Morgan Stanley and Goldman are reporting neck and neck.
How much savings does he have off these Goldman Sachs cuts of the last week?
He has some leverage there. He has some leverage there. And the question is, remember, some of those cuts are not even from this consumer business. About a third are coming from the traditional businesses, which again are making money. So the competitive dynamic here going into next week, we've got to keep an eye on very closely.
Shanali, awesome. You're going to be with us through the hour, breaking down some of these numbers. Bank of America, JP Morgan numbers still to come this morning. Going into all of that, equity futures negative about 0.1% on the S&P 500. Live from New York City as we close out a trading week and kick off earnings on Wall Street. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. In Germany, the economy probably stagnated in the fourth quarter. That's easing fears that the war in Ukraine and inflation have triggered a recession. For the year, GDP rose 1.9%, just ahead of the estimate in a Bloomberg survey. Meanwhile, the UK economy may avoid a recession for now. Gross domestic product unexpectedly rose 0.1% in November. The reason? Consumers kept spending through the worst cost of living squeeze in memory. The new numbers would strengthen the case for higher interest rate hikes. President Biden's handling of classified documents erupted into a political crisis with potential legal repercussions. A special counsel has been named to investigate. Meanwhile, the White House has confirmed that a second set of documents was found in a garage storage area in the president's home in Delaware. Tesla slashing prices in the U.S. and major European markets after several quarters of disappointing deliveries. The electric car maker lowered the cost of its cheapest Model Y by 20%. Buyers can save as much as $21,000 on Tesla's most expensive vehicles. And the only child of Elvis Presley has died. Lisa Marie Presley had been rushed to a hospital in a Los Angeles suburb Thursday after suffering cardiac arrest. She was a singer who earlier this week appeared at Graceland, the mansion where Elvis lived in Memphis, Tennessee. Lisa Marie Presley was 54. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Season is here.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit.
Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Take this very seriously. The president takes this very seriously. He was not aware that the records were there. He does not know what is in the documents. Again, classified information, classified documents, he takes very seriously. When they were discovered, and this is the right thing to do, right? His lawyers reached out immediately to the archivist
The president finding himself in a little bit of hot water. That was Karine Jean-Pierre, the White House press secretary, live from New York. In the next couple of hours, our attention switches to earnings in America, on Wall Street, Citi, Bank of America, JP Morgan, all coming in the next couple of hours. Going into equity futures, totally unchanged on the S&P 500. Three-day winning streak on the S&P. And would you believe it? The three-day winning streak on the S&P, longest daily winning streak since early November.
Since 1964.
TK, it's been that long. Yields are up by a basis point.
It's a new feeling.
345.40.
This is important. It's a new feeling out there, John. And I think the gloom crew has been silenced. They reaffirmed their gloom, and the optimists are going, well, this happened fast.
How about that 10-year, Tom, from 433 in October down something like 90 basis points?
I did a very careful study today of the trend of the 2-year yield, and I can't say yet it's broken down. I mean, other technician types can say that, but I can't get there yet. But it's made some real headway.
Hey, we're down 30 basis points on the year so far at the front end.
2 comes in, negative 67 basis point. Right now, she's outside a Corvette dealership. Anne-Marie Horton joins us, Bloomberg, Washington correspondent. Anne-Marie, do we have a clue what documents were next to the Corvette in the garage besides how to change the oil?
We do not know. There's a lot of questions that remain unanswered with this unclassified document story regarding the Biden administration. What we do know is that there were classified documents that should have not left the White House at the Biden Washington office that he used after he was vice president, and then, of course, at his house in Wilmington, Delaware, in the garage, which is, if you missed it yesterday, the president was asked why he kept these documents next to his Corvette. And he, made a quip that has basically gone viral, and I'm not sure it really helps his case, saying that, well, by the way, my Corvette is locked up, insinuating that the documents would have been safe if they were in a locked garage. But there's a lot of questions, and the White House really wants to make sure that they are not giving details on this and just leaving it to the Attorney General, who now has announced a special prosecutor, Richard Hur, and he is going to be the one that is in charge of this. So the timing isn't great, though, for the Biden administration, given the fact that he potentially was going to make a run, announce his campaign for 2024.
Well, give us the famous, John, you've heard about this, the famous Hoarder and distraction measure. It's a very important meter. How much of a distraction is this for Democrats in Washington? Is it a kerfuffle, or is this something tangible?
So at first it looked like an isolated incident that maybe was minor and they can move past. But then you had the revelation of second documents, which first was reported by NBC News, and then the White House came out with a statement. So this is the second time that a news organization came out about the statements. First it was CBS, and then the White House followed with a statement about the documents, So this is a lot of questions to the White House about why didn't they disclose it to the public in statements before it was scooped by news agencies. That's for one. And the second is when they came out and talked about the disclosure of the first batch of documents at his office, why didn't they talk about the fact that there was a second set of documents at his house? So now this has become much more of a difficult political story in Washington, D.C., especially the fact that there is also another special counsel that is investigating the former president. And Biden has made very clear that what Trump did was completely reckless. And while there's very different facts and really just how this has kind of unfolded in terms of the Biden administration is working with the lawyers, the National Archives, and the Attorney General, which we did not see with the Trump administration for basically over a year. The fact is, politically, this is going to muddy the waters.
Hey, Mitch, let's talk about policy, if we can. Is anything on the agenda as we kick off the year?
Well, on the agenda for the Biden administration is really going to be foreign policy, and that's going to be on full display today when the Japanese prime minister comes into town. For policy domestically, it's going to be very difficult, right? You already see House Republicans moving forward with bills that will never, ever get a sight on the Senate floor because the Democrats control the Senate. So gridlock completely in Washington unless it's those must-pass bills, which we've already talked about, are going to come down to big fights.
MH, down in Washington. Anne-Marie, thank you. As always, ton of earnings coming through this morning. Let's kick things off with BlackRock for you. We'll start with EPS for the fourth quarter. I'll get to that important AUM number as well over at BlackRock. Adjusted EPS $8.93, the estimate $8.08. AUM, 8.59 trillion. Yes, that's a T, trillion. The estimate, 8.38 trillion. Hearing from the CEO, Larry Fink, flows positive across each of our 3 regions. The restructuring charge, Tom, $91 million from job cuts. I think we might see a lot of that across the industry.
Yeah, the BlackRock prides themselves on clarity. They got a beautiful presentation, 15 pages that they come out with. And the answer is you take 91 million and you divide it maybe over 90 days by 4.3 billion. So it's 91 divided by 4,300. It's a, is it a rounding error? No, but, they're probably spending as much on coffee in their food courts if they're still buying coffee for their employees.
Hey, to your point, cost discipline. Isn't that going to be a feature of this quarter?
Well, they love it. I wish we had Brian Moynihan here to sit in with us today. Lisa's on assignment, but the answer is, they're genetically linked to cost cutting. That is the solution at all costs.
The story in just the last couple of days, Tom, BlackRock planning to cut 500 jobs in the first retrenchment since 2019. It's been a while, and I think to the point that the Goldman cuts we were talking about as well. I think Srinath Rajan's done a decent job of this, Shinali Basak as well, just indicating that, Tom, through the pandemic, the cuts that we typically made, weren't made. And now they're all being made at once.
Yeah, and I'm in the camp where they're using this, is that's 2.5% of their workforce is published by Bloomberg. See this, folks, on the description screen, the acclaimed DES screen. And John, I defer to, say, Paul Sweeney, who I think is way more knowledgeable about this than I am, helping me at 9 a.m. on Bloomberg Radio. And Paul would tell you 2, 3, 4% is normal. And if you go to a percentage cut at Bank of America, whatever bank that's Tesla-like or Salesforce-like, that's a different story. Are we going to see that in the earnings season here starting in this hour? I'm not sure.
Do we get the Mike Wilson of Morgan Stanley kind of earnings season that he expects?
In banking.
And beyond,
don't think
in
we
tech.
will.
You don't think we will in banking, but in tech?
I think they're in process right now. Maybe they've gotten out in front of it. It'll codify in earnings statements, but let's remember, John, if they let 42 people go in mortgage finance or whatever's flat on its back, they're probably hiring 45 people to code computers, when they're not at the monkey bar having lunch.
Well, to be clear, it might be easier to get some of those coders if you want some of those engineers from those tech firms, if you're one of those big banks on Wall Street, because that story over the last 10 years has been the story.
But is that who the tech firms are letting up? As you mentioned, the tech firms didn't lay off in the pandemic, nor did anyone else. Who are the tech firms laying off is a big question.
Are we done with that? Amazon went into the pandemic with 800,000 employees. Came out the other side, Tom, pushing 1.5 million, 1.6. And those numbers over 2-3 years are monstrous. I can't believe how comfortable we've all got with it. Kind of just sort of gloss over the numbers.
To me, the
to go
big
from
mystery,
800K and double your workforce in 2-3 years.
Just to pick on Amazon, in the conference call, how will they verbal the speed of change that they're doing with those big warehouses across this country, which, is a generalization, they overbuild. It goes to what we talked about with Goldman Sachs and Shinali Basak, and Srinath Rajan nails it in his story this morning. This isn't about losses at the consumer experiment of Goldman Sachs. It's the rate of change is moving in the wrong direction.
February 3rd for Amazon, if anyone's interested. Today, we're going to get numbers from JP Morgan and Bank of America. Up next week, we'll hear from Morgan Stanley and from Goldman Sachs as well. Your equity market, just a little softer, down 0.1% on the S&P 500. In the next 60 minutes or so, you'll hear from B of A and from JP Morgan. Citi coming up a little bit later this morning.
started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Getting some earnings a little bit later this morning, waiting for Bank of America, then on to JP Morgan and to Citi as well. Equity futures going into it down about 0.2% on the S&P 500, coming off the back of a three-day winning streak on the S&P. As I said a little bit earlier this morning, that's the longest daily winning streak since early November, believe it or not. In the bond market, we look a little something like this on 2s, 10s and 30s. Your 10-year yield peaked at about 4.33 back in October, all the way back down to 346.50. Yield's just a little bit higher this morning by a couple of basis points on a 10-year. On a 2-year, unchanged at 413.55. Ended the year 2022 on the 2-year at about 426. So this is quite a move lower over the last couple of days. That's the move of the bond market. Let's finish on foreign exchange for you. In FX at the moment, we shape up as follows: 108.14 on the euro dollar, negative a third of 1%. That has not been the trend. Has not been the trend at all whatsoever since September. We have had a much, much weaker dollar. The DXY dollar index down by more than 10% over that period, Tom. It's been a tricky moment for both the bond market, yields lower, and then you've seen what's happened in the FX market, dollar weaker.
Yeah, it's a trend that's in place, and there is some argument. We've seen argument today, this week, John, on Bloomberg surveillance on dollar trend, and there's some people that question the durability of dollar weakness, and that'll be, I think, a debate, certainly to the February 1 Fed meeting.
Looking at the moves elsewhere, not much happening here, Tom. Maybe looking at Japan, perhaps, into the BOJ next week with that 50 basis point move. 50 basis points the target, yield curve control, just going through that briefly. I don't think that's a major move at the moment into next week, Tom, but certainly it's a threat to the credibility of this BOJ, and we'll see if they back away again.
As we await for earnings in the beginning of the season, they are coming out. John, we had American Airlines surprising yesterday with some numbers, and Delta here just very quickly, traffic down 10%, capacity down 9%. I'm going to call it a bit of a miss, and maybe there's a bit of a lightness in the stock here in the second since Delta Airlines.
It sees the first quarter adjusted EPS at 15 cents to 40 cents. Tom, that's quite a wide band, isn't it? The estimate 54 cents. Before that, fourth quarter adjusted EPS 148, the estimate 130. You mentioned passengers, Tom, passenger revenue, Delta Airlines for the fourth quarter, 10.89 billion, the estimate 10.6. The fact of the matter is these stocks have had a massive run, so Delta's down about 1.8% in the pre-market. I mentioned where they were, Tom, and what they've done so far this year over 8 trading days. Delta's up about 20% plus.
Yeah, I mean, it's been a real tangible move, and I think there's a mystery here, particularly on domestic business travel, seems to be what the sell side's looking at. What we're going to do right now with some free minutes here before the earnings extravaganza begins is drop in Shanali Basak here. And this is something I've talked to our colleague Sri Natarajan about, but I want to go to you on it with the Financial Times today, looking for the future of Carlyle. We should note that David Rubenstein, one of the founders of Carlyle, is very active with Bloomberg Television. In radio, and this goes to two guys who are exiting or rumored to exit: Mark Mason at Citigroup, ex-Goldman Sachs and Lucent, and also, of course, Mr. Prusen reported the other day. And what I find fascinating in the turmoil of what we expect to see cost-cutting, do we expect to see all of these companies really begin to rationalize succession path?
Absolutely. Remember, a lot of these folks have been in these positions for a very long time, especially at the big banks, where there has been a lot of lack of movement at the very tippy top of the banks. Some people have been there for a certain amount of years now, so it's a progress story for Jane Fraser and for David Solomon. But when you look over at Morgan Stanley and JP Morgan, it's that second rank you have to really worry about attrition. Some people are retiring, right? You see that in a recession.
Pruzan stepped aside last week at Morgan Stanley.
But he's been there a long time. The reason Jonathan Pruzan is so interesting is because that CFO role and COO role at Morgan Stanley, think Ruth Porat, over to Alphabet. John was somebody you long watched and to see what his next move would be.
What about Mark Mason with Jane Fraser at Citigroup? I mean, is he a Jane Fraser acolyte or is he from Corbett and another time and place?
They moved together. And Mark Mason and Jane Fraser are, the left hand and the right hand. And so
I think she speaks to them on a daily basis, Tom.
Yeah.
I also kind of like sit outside and camp out outside of the banks. But the reality is Mark is very close to Jane and a very important part of her turnaround story, whereas John Pruzan, of course, very important in Morgan Stanley, but the ranks are full there. The succession plan is thick, and it makes sense if he were to go into somewhere like private equity, especially, by the way, at a place like Carlyle, where the politics are very, very, very challenging. So to have a CFO, COO type to kind of smooth a lot of that over makes a lot of sense.
Shanali, stay close. We'll break those numbers with you when they come out, waiting for BofA and JP Morgan in the next 60 minutes or so. Jared Cassidy with us now, the head of US Bank Equity Strategy and Large Cap Bank Analyst at RBC Capital Markets. Jared, first to you, sir. What are you looking for from BofA?
And what we're looking for Bank of America, as well as some of its peers, is the expectation of very strong top-line revenue growth. That comes from net interest revenue. As you know, John, the rise in rates has been very favorable to all the banks, particularly for their net interest margins. The right side of the balance sheet for the first time, John, in the last 15 years is really important now, meaning you need cheap core deposits, and Bank of America has that. Now, on the other hand, we're going to see weak capital market numbers from Merrill Lynch. So it's going to be a tale of two cities for them, as well as the other big universal banks.
This conversation, Jared, about peak net interest margins, are we approaching that peak, at that peak? Is that peak behind us?
I would say what we're going to see is probably peak net interest margins in the first half of 2023. But the important number for everyone to focus on is not the margin necessarily. It's net interest revenue growth. We're still going to see double-digit net interest revenue growth for Bank of America and its peers in 2023.
I mean, Gerard, we've got three companies coming out at once. It's a bank extravaganza just to make you go further gray like me, trying to catch up with me. And Gerard, what I find fascinating here is to take a traditional ratio like tangible book, or I'll let you decide, return on assets, parse those three banks. Am I right that JP Morgan is more profitable than the other two?
Tom, you're right. Certainly, JP Morgan, as measured by return on equity or return on tangible common equity, is more profitable than Bank of America and Citigroup. Bank of America, of course, is more profitable than Citigroup. And Citigroup's biggest challenge is that they just don't have the strength in the United States in the consumer banking business. Bank of America and JP Morgan do.
You know, I look, Gerard, I'm bringing it up here on the Bloomberg. John, the function is the GP function. You bring up a chart on.
Oh, wow, thanks for that. That's useful. Shanali, have you heard of that one before?
Thank you. Gerard, I got Citigroup trading collegially at $49 per share, but fossils like you and me do a reverse 10-to-1 stock split. Is this stock still trading at $4.90 pre-Great Financial Crisis?
Tom, that is the math. That's exactly right. And it's unfortunate. Citigroup at one time was one of our premier banks in the United States. And unfortunately, they still have not fully recovered.
Our David Weston scheduled to speak with Ms. Fraser at Happy Valley in Davos. How happy is Jane Fraser right now? What is the urgency for them to launch off of $4.90, $5 a share?
Tom, it is there is a sense of urgency, but we have to remind ourselves they're turning around a giant ocean liner. It takes time, and unfortunately, the conditions in which they're turning it around, the rough seas have been awful for them. So the timing of the turnaround has been very difficult due to what's going on in the world economy, and of course with the tragedy in Ukraine.
Joe, can we just sit on JP Morgan just for a moment? 12 months ago, there were all these big questions that have been presented to Jamie Dimon in a fashion that hadn't been in a long, long time, if ever. That was about cost discipline and the amount of money they were spending. And in the last 24 hours, the last couple of days, renewed renewed focus on the amount of acquisitions and perhaps some sloppiness creeping in as well, Jared. I know they're not massive acquisitions. For the size of this bank, they're not huge numbers. But, Jared, what are you focused on?
We're focused on the core banking businesses, John, and that is, taking in deposits, making loans, of course. That's a core function of any bank, as you well know. But it's also looking at their investment banking and trading businesses. Even though investment banking revenues for them in the industry will be down well over 50% year on year in the fourth quarter, the trading revenues should be pretty good. But to your point on expenses, JP Morgan has had the higher level of rate of growth in expenses, and that will certainly be an area. And unfortunately, they got caught in a fraud on their most recent acquisition, which of course was disclosed this week.
Shanali, what did you make of this? Just the last 12 months, and not the last couple of days, but the last year for this bank.
For JP Morgan?
Yeah.
So the interesting thing is they do have, if you look very closely, they do have some retirements that have been coming. They have not been the Goldman Sachs of the world where they said we're going to cut thousands of people on our head staff in terms of headcount, but they have seen cuts at the mortgage business. So they've held steady. So that does put pressure on expenses relative to, say, Goldman Sachs. So do they start to make those moves as the environment softens? I'd also say they sidestep some problems. You saw Bank of America go heavier when it came on to risk-taking, especially in the leveraged finance market. But, JP Morgan has the biggest fixed income desk on Wall Street. So you saw another $70 million of losses there in European high-yield trading. So do they have more caution, I think, is my question for this year.
The stock has ripped as well since October. From the October low, JP Morgan's up about 37%. Jared, let's speak to that. The performance of the equities of the stocks coming into a new year. What do you make of it?
John, the banks are doing well, as you just pointed out, since October. It's been very impressive. But even year to date, the banks are outperforming the general markets. And the reason being is that I think investors are discovering that the economy is still very healthy. The real GDP now number coming out of the Atlanta Fed is pointing to a 4+% real GDP growth number. So the likelihood of a recession in the first or second quarters of 23, I think, is quite remote. Now, the second half of the year, that might be a different story. But it's this net interest revenue growth. Investors are recognizing if the Fed keeps Fed funds rates around 5% for an extended period of time, banks like JP Morgan, Bank of America, they're going to do quite well in that environment.
Well, Joe, to that point, how tethered are they to what happens in the bond market? Because yields have been falling to start the year, but the bank equities have carried on performing.
Yeah, it's a good point because it's interesting. The volatility in the markets last year helped, particularly in fixed income trading. It really helped JP Morgan and others. So believe it or not, if you get a less volatile market, the market's revenue may be affected and weighed on that. But then you hopefully offset it with stronger debt capital markets, investment banking. But the lower yield, that's a good point because now the mark-to-markets in their bond portfolios will be less, which means there'll be an accretion back into capital when those marks come through at the end of the first quarter.
Jared, you're sticking with us, I'm happy to say. Gerald Cassidy there of RBC Capital Markets on the big banks as we wait for Bank of America and JP Morgan. Tom, we talked about JP Morgan and not the hurricane. Jamie Dimon backing away from the idea that a hurricane is coming. Kind of tamed down, I would say dialed back his language earlier this week.
I think he's trying to get out to 100 pages on his annual letter this year. John, I have a chart. It's super secret on a need-to-know basis.
I could tell you were distracted. What are you looking at?
I'm looking at the 5 banks back to the great, make it 6 banks back to the beginning of the great financial crisis. And basically, there's Citigroup lagging big time, as Mr. Cassidy said. The other 4 bundled in collegially. And then there's Fortress Diamond. I don't know what happened with the Kool-Aid at JP Morgan late 2016, but it's a moonshot over the last 5 years.
Equity futures right now, down 1/3 of 1%. Bank earnings on Wall Street coming up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Alabama and Georgia, violent weather killed at least 7 people. Much of the damage took place in Alabama, where a tornado cut a 20-mile path across 2 rural communities. 6 people were killed and more than 36 homes were destroyed or damaged. The FAA is out with preliminary findings on the computer failure that grounded all departing U.S. flights on Wednesday. The agency says it was caused when a data file was damaged due to a failure to follow government procedures. Now, according to the FAA, unspecified personnel were responsible for corrupting the file. It's a major boost to one of America's top exporters in its most important foreign market. Boeing 737 MAX returned to commercial service in China after nearly 4-year absence. China's Southern Airlines operated the flight. A Chinese airline hadn't flown passengers on a 737 MAX since the plane was grounded in 2019 following 2 fatal crashes. China's exports keep falling as global demand continues to drop off. Exports in U.S. dollar terms declined 9.9% in December from a year earlier. That was better than expected performance. Still, it adds pressure to an economy that's trying to recover from COVID-0 restrictions. And a big pay cut in the works for Tim Cook. Apple is reducing its CEO's compensation by more than 40% to $49 million this year. The company is citing investor feedback and requests from Cook himself to adjust his pay. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Earnings on Wall Street begins right now. Let's get you some numbers. B of A fourth quarter trading revenue comes in at $3.72 billion. The estimate $3.31 billion. Fourth quarter EPS comes in at 85 cents. There's a ton of numbers here. Trying to distill it all. Shanali Basak alongside us.
She's got them all before us.
What do you see?
Here's the problem here. You do have net interest income, which is the most important number this year for Bank of America, coming in light of expectations. It begs the question, where does the money come from? Even with rates rising, are consumers borrowing? Are businesses borrowing? Businesses have been very highly levered. We're going to look very closely into where those numbers are coming from. Provisions for credit losses of $1.1 billion increased $1.6 billion, according to Bank of America. So you do see an increase there in provisioning. The environment here potentially deteriorating.
To be fair to you and grizzled pros like Gerard Cassidy, when you see a headline that says fourth quarter net reserve build of 403, you can't analyze this stuff over a cup of coffee in 12 seconds on financial TV, can you? You got to dive into it.
You have to dive into
what are you going to dive into when you're done with us and you're working feverishly here? None of you see this, but she's killing herself while she's not on air. What are you going to dive into?
So you have to think about where those softness numbers are coming from. Is it continuously the mortgage market? There's a little bit of worry about the auto sector here, and those things are persisting into this year. I will also give them the victory lap here on the institutional businesses because they had a strong beat in fixed income. They're having the highest results ever in trading. And so for Brian Moynihan, which restructured a business here in terms of talent about a year or so ago, it's a very big deal after the departure of some seniors trading executives that they're keeping winning share there, especially with softness in the European banks in a tough market. So fixed income is up, equities met, but the consumer here is where there is weakness relative to what was expected.
Gerard Cassidy with us too, with all of his work at Tucker Anthony over the years, and then RBC Capital Markets. You know, I dive into the press release and the propaganda from Fortress Moynihan Gerard, and just as a basic idea, digital logins, 3 billion, digital sales grew 8% and represented 49% of total sales. 2, 3, 4, 5 years from now, Gerard Cassidy, are all of these banks digital enterprises?
Tom, Bank of America has been the leader in pushing the digital channel better than anyone else, even JP Morgan in our opinion. But we're always going to have the multi-channel approach. I don't think you're going to see branches ever disappear. Now, the amount of business going through the digital channel will continue to grow. So you're right. I think you're going to see companies like Bank of America, JP Morgan Chase, and others continue to drive profitability and product through that digital channel because it's convenient to consumers, but and also businesses, but it's also more profitable to the bank.
Bank of America right now up by 1.25% in the pre-market. JP Morgan numbers are out as well, so let's run through those numbers right now. Investment banking revenue comes in at $1.39 billion, the estimate $1.66 billion. So that comes in light. Ton of numbers to go through here. Overall revenue then, just a little bit lighter on investment banking. Headline revenue, adjusted revenue for the fourth quarter, $35.57 billion, the estimate $34.15 billion. Just a bit of commentary from Jamie Dimon, the CEO, able to resume stock buybacks this quarter. Going through the numbers again, Shanali, what have you got?
Listen, one big concerning number is fixed sales and trading falling below expectations. The other concerning number is the provisions for loan losses, as we're talking about concerns about the consumer moving forward, coming in almost $300 million more than expected. That is well over $2 billion of provisions for loan losses. So the commentary moving forward about whether Jamie Dimon's hurricane and whether you think it actually comes into fruition is going to be super important. When you have weakness here on consumer and investment banking, to your question moving forward is where do the expense disciplines come from moving forward? So yeah, I mean, you have people tweeting not pretty when you watch some of their core businesses here fall short. Sets up the stage very strongly for Goldman and Morgan Stanley next week.
We've got to talk about those provisions for credit losses. Jared, I want to come straight back to you on that, both at BFA and at JP Morgan. That number there, the fourth quarter provision for credit losses, $2.29 billion, the estimate $2.05. What should we read into that?
John, I think it's a positive number, believe it or not. Sounds counterintuitive when you hear that, but you have to remember the new accounting for credit losses known as CECL, current expected credit losses. The banks have to do life of loan loss analysis. So they have to anticipate a recession over the next 12 to 18 months. And so building up reserves in the fourth quarter of 2022 is smart because most investors are looking at 2023 earnings. So they were able to build them up and still report bottom line numbers that were better than expected. But I would point out that we're going to see the banks continue to build reserves in case there is a recession. Right now, it looks like we're going to at least have a slowdown in the economy and possibly a shallow recession. So by building up reserves, we would take that as a positive because they still can beat numbers and still build up reserves, which gets to the point. You talked about it, John, the bank's doing better this year. This is what investors are saying, is that you can build up reserves and still report strong earnings because the revenue growth from spreads are quite good.
So, Shanali, this is pretty important stuff. Just how high quality is that loan book going forward into what could be a tough year, might not be a tough year? If you ask an economist right now, they've got no clue.
Yeah, JP Morgan's quarter includes $1.4 billion worth of reserve build. So, I mean, to Gerard's point, bringing this forward makes a lot of sense. It puts the bad news behind them. But when you look forward, 20%, to Tom's point, tangible return on equity here, that is through the roof. That is showing you that JP Morgan has leverage here when it comes to expense control, to posting those numbers. That 20% is nothing like you're going to see anywhere else.
Gerard, if you and I parachuted on this from other bank worries that we've had over the decades, I have real trouble with any kind of angst and hand-wringing here. I would say and suggest respectfully, Gerard, that they're literally trying to hide their profit. I look at the operating income of JP Morgan wrapped around a tangible return of 20%, 2-0, and they launched from, I believe it was $45 kajillion pre-pandemic, and I don't know what that number is right now, but it's a near double, Gerard. These guys are minting money, right? Are they underplaying it?
I think you're right. And once again, we have to come back to something very straightforward, which we haven't looked at in 15 years, which is the core deposits. And because the banks are in a Fed funds market that is approaching 5%, think about this, Tom. A commercial loan to a worthy borrower will reach 8% sometime in the spring of this year. And the cost of funding that, think of the checking account deposits. Banks don't pay interest on checking account deposits for consumers. That's an 800 basis point spread. Think back to where pre-pandemic, when the Fed was at 0 to 25 basis points, or during the pandemic, you didn't get those spreads. That's what this is showing.
I literally look, John, here, just to make a comment on this, is I am looking at them no different than I look at a luxury manufacturing company with Dana Tulsi or any other sector. I got to go back and look pre-pandemic and what everybody, including Mr. Diamond, Mr. Moynihan, and the rest went through. And these guys, I would respectfully suggest, are literally trying to hide how much money they're minting.
Getting that commentary on the outlook from Jamie Dimon in the press release, the U.S. economy currently remains strong. Still don't know the ultimate effect of these headwinds. Jared, you know the commentary over the last 12 months or so, will those headwinds turn into a hurricane or not? It's interesting there's a line in here about the ability to resume stock buybacks this quarter as well. Jared, can you run me through what you expect from capital returns at certain banks on the street through this year?
John, you just brought up a great point. the buyback being reinstated. That was not expected. That's the positive surprise here. You might recall this company was struggling with their capital levels in the second half of the year. So now, as we all know, these banks are generally paying out 30 to 40% in dividends. And prior to the pandemic, when there was minimal loan growth, it was quite often you saw a buyback that represented the other 60 to 70% of earnings. Then they all turned it off in the second half of this year, including Bank of America and Citi. And now for JP Morgan to come out and say it's back on it and put up numbers like this, it is a very strong statement, in our opinion, that the bank has plenty of capital and it's going to be able to grow and support its basic banking functions, but at the same time, give back even more capital in 2023.
How conservative do you think they will be, Gerard, given the reserve build that we're seeing? How conservative do you think they will be with capital returns in the year ahead?
I think they would be on the conservative side, not so much dividends. Again, dividends are pretty set. And that's another important point, John. If we get through this cycle without any of the banks cutting dividends or eliminating like they did in the financial crisis, that is a huge positive for the banks for revaluations coming out of this. But I think you're right. The buybacks will be more limited than what we saw back in the pre-pandemic period.
Gerard, very important question, and all of us, all our viewers and listeners know this, that these banks are the moonshot in credit card interest rates with a higher interest rate regime. Some of them are buttressed up against 28, 29, 30% per year. Is the credit card business stable for consumer banking in America, or do they have to go out and basically co-op fintech with their ginormous profits?
Tom, it's interesting, the fintech threat that many people were concerned about 3 or 4 years ago has really been thwarted by the banks, as the banks have themselves been quite aggressive in investing in technology, but also in core banking businesses like credit cards. To your point, that's where consumers want to go for their credit cards and other businesses. But you bring up a good point. The yields in credit card portfolios are generally in the high teens. Yields. And as a result of that cheap funding, it's quite good.
You sound like a lobster farmer up in Portland, Maine. You're yielding lobsters instead of killing them. John, this is an incredibly lucrative business. Single line, JP Morgan, debit and credit card sales volumes up 9% due to the Bassick household.
It's all shenanigans. It's all to
That's
shenanigans.
what it said.
Hey, Gerard, thank you. We've got to let you go.
Come on, it's 28% business. That's called a loan shark business in my youth.
Gerard Cassidy,
28%
of RBC.
yield?
I don't know if you want to associate them with loan sharks.
No,
I'm sure they've got something to
I
say
say
about
this
that,
with
Tom.
immense respect to these banks, but everybody's worried about loan loss reserves. I've never seen 20%
They're willing to
tangible
pay
equity.
for those clients, though. You know, $800 million of the reserve build is in the card business. And so you're seeing volumes rise. You're seeing reserves built. They're taking on risk still, which means that how concerned really are you about the consumer?
Just for the outlook briefly, over at JP Morgan, seeing 23 net interest income at about 73 billion. The estimate is 74.43 billion. The stock just a little lighter, softer in the pre-market. Also hearing from Wells Fargo as well. It's a miss on revenue, but expecting to resume stock repurchases in the first quarter. More still to come. Citi just around the corner. Equity futures down 0.4% from New York. This is Bloomberg.
Happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This whole episode will turn out to be transitory. But the reason why it's transitory is because the Fed reacted.
The Fed is a risk manager. I think they need to stop. This is a war that they've won, and they're in danger of tipping the economy into recession. I think they're making the fiscal problem worse.
It's the prevailing view now, and I think it's right, that we're heading lower in inflation, and we've seen a peak.
Inflation has a number of parts to it. John Williams talks about the inflation onion. We've gotten the good news on the outer shells.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Equity futures down about 1/3% on the S&P 500. Shonali Basak alongside us this morning, breaking down the bank earnings. JP Morgan, Bank of America, Wells Fargo behind us. Coming up is Citi. Got to start with JP Morgan if we can get straight to the stocks in the pre-market. JP Morgan, a little softer, lighter, negative in pre-market trading. Fourth quarter numbers, not of a massive concern. It's about the outlook here. Yeah. Down about 3.5%. So let's run through the outlook line by line. 2023 net interest income of about $73 billion. The estimate's $74.43 billion. Just a little bit of a line here about a modest deterioration in the firm's macroeconomic outlook. And Tom, off the back of some of these headlines, the stock just a little softer. I wouldn't say this is a massive dramatic move across the banks this morning, but certainly gets your attention.
Let me posit a question, and you and I grind this out every day on surveillance. Are these bank executives any different than the pundits we interview? They're trying to get out and game and guess an economic slowdown of some character. Because these are, to borrow from Variety in Hollywood, these are Buffo earnings. These are really good, 20% tangible return. Okay, fine, but the gloom, not the gloom, the tone, the tinge, John, is the first quarter, second quarter could be a real struggle.
It's the reality of the moment that we're in. We've come into 2023.
Fair, yes.
Asking ourselves a really simple question that's difficult to answer. Are we meant to be pricing in a growth slowdown off the back of all the tightening? Are we meant to be pricing in a growth rebound off the back of what's happening with China and the relief we're seeing in Europe? I don't think anyone can answer that question with confidence. So what do you do if you're running a bank? Super conservative business, you build reserves.
You build reserves, I get that, and I thought Shonali was very articulate on that in terms of the fact is there is a credit buildup, so you naturally build reserves. But far more than that is just the reticence here post-pandemic And all of the economists, Torsten Slok yesterday and others saying we're still in supply side shock. I would suggest these leaders are managing out 100 days with far more acuity than they were 5 years ago.
Shonali, you've been running through this. Just a short, quick word on what you're seeing so far.
Think about how incredible this is for the coming year. You have $66 billion, $67 billion in net interest income for JP Morgan. The expectation is $73 billion this year. It's hard to think that that's a bad year for JP Morgan ahead of it. And the idea that it just posted, we were talking about this in the break, 20% return on tangible common equity, even with missing on some business lines, while cutting bonuses, tells you the banks still have leverage, and that is with headcount rising, compensation costs rising, and tech expenses are actually down. So how they use that money is going to be absolutely fascinating in the year ahead.
I look at the financials here, and let's go back to that social consequence right now. We have a lot of viewers. For those of you worldwide on global Wall Street, and particularly New York Wall Street, thank you for tuning in each and every morning. These people, you know, there's some quant out there that's going to get a triple bonus because they got oil right last year and shorted it. Other than that poor soul, everybody else is getting hammered. How are they supposed to respond when they see the ratios that I see on these printouts?
I think what's difficult here is knowing where you're supposed to work on Wall Street. There are some businesses that are under serious pressure, like mortgages. And if you look at that, that is continued on, right? To your point on quants, great year, but does that also continue? These are super, super cyclical businesses. What JP Morgan is showing you in their numbers is that they're willing to hire more, but perhaps you'll make less under a bigger workforce.
That stock negative right now, 2.9%. The broader equity market futures softer by a third of 1% off the S&P, coming off the back of a three-day winning streak on the S&P 500, longest winning streak going all the way back to November. In the bond market, yields just a little bit higher by 2 basis points, 346.31. In front of us still, about an hour away, we'll get numbers from Citi. Let's get to Ken Leon, Equity Research Director.
Reported today that's going to give analysts more confidence to look to a more constructive first half as we cross the valley to potentially a stronger recovery in the second half of next year. That's a big story.
So Ken, you think we'll be talking about reserve releases pretty quickly?
Reserve releases won't happen until probably the third quarter. Again, we're near historic averages just by building reserves right now. We don't have any distressed industries, and the consumer is still fairly strong. As Shonali says, they're also banking net interest income.
Is there a point here in the tensions of post-pandemic America to be strategic? And if not acquire banks, maybe they can't, the government won't let them. But is there a strategic vision for these banks to get larger?
They're too big, Tom. And also from a regulatory standpoint, there's going to be added pressure. We're going to be talking in February about a new leadership for the vice chair supervisory, Michael Barr, who's going to increase the capital buffers. So, you know, they have way too much capital. It's about more aggressively lending it. So I don't think size is an issue on adding banks to these, but it's more of taking advantage of their deposits for increased loan activity. So things are more constructive today than they were even 30 days ago.
Thank you. I think that's a really intelligent comment. And with that momentum forward, what I see within the, you know, the verbiage and the PR of these press releases is these banks are steeled to deploy cash to shareholders. When they start on January 1 of this year or next year or 2 years out, when they start on January 1, what's your immediate cash-on-cash return from these big banks? Can I dare say it's 8%, or is it more of a reasonable 6% immediate return?
Well, they're going to certainly look to how do they manage the regulatory regime and really what's required, you know, related to the Dodd-Frank stress tests and other capital ratios. These are still regulated businesses. So there isn't this unleash of all their capital, but it's there. So if you're a portfolio manager, you're saying, I have high quality companies, these large banks that are flushed with cash. There is return of capital with dividends and buybacks, not like Disney. and they're trading substantially below the S&P 500. To me, that is an opportunity to let these banks ride the wave of recovery.
John, can we start a surveillance rumor today that Nelson Peltz is going after J.P. Morgan?
I think that was
Would that work?
I think that was a dig at the Walt Disney Company. I'm not
think
sure where
was.
it came from.
Well, Ken Leon, entertainment analyst, is with us.
That was certainly a dig. I don't think Shinali wants any part of that. Bank of America right now is positive 0.7%. JP Morgan up by 2.5%. We've got a range of banks here. Shinali, we've got B of A, JP Morgan, Wells Fargo, Citi ahead of us. What does all of this tell you about what we might see from Citi?
I think trading is going to be a tough thing to look out for Citigroup. I think the reason that is so important for Jane Fraser is because as she pivots this bank, she wants to show that even though she's building wealth, she is she's kicking it in trading businesses. This is a talent story. This is a time the buy side is growing. The global picture for rates, currencies, commodities has been a killer business for Wall Street. And so she wants to show some winning there. The place that Jamie Dimon at JP Morgan said they were weak at was securitizations, really. So that is where the fixed income business is weak. Again, I will have to bring up what kind of headcount reductions would we see on the back of weaker businesses?
This is a question for Gerard Cassidy or Ken Leon. These guys are steeled in this, but I'm going to go to you on the more social aspect of this. Is there room in America for 4 big banks?
Yeah, absolutely.
5 big banks?
Well, you have to remember...
There's room for Citigroup here to struggle and try to catch up over 15 years from the great financial crisis.
I think you have to watch how these banks are changing because a lot of these banks are not the banks that
Is Citigroup a big bank?
Citigroup is becoming a big wealth manager. Did you used to call that a bank before? I mean, these are not companies that are lending to homes across America anymore. And you have to ask yourself, as European banks get really weak, do these banks start to find assets to buy there, a chance to grow fairly cheaply at a time where the market there is down?
Ken, you get the final word here. Ken Leon, favorite part of the equity market in 23. What is it?
We're going to see a brighter outlook for 2023 for the banks. That's a change story from where we were before.
You're not alone. I've heard that from a few players, Ken Leon there of CFRA. I think it was Savita Subramaniam of Bank of America who said these are not your mum and dad's banks. They're much more defensive, completely different, going into a recession if we do have one, because I know there are some different opinions of whether we might get one in the United States. If we do have one, there are people out there that think these banks do okay.
Dead on. And the guy that was way out front on this, I have to give credit to Charles Peabody, who's an incredibly thoughtful bank analyst. Gerard Cassidy, was way out front on this. You're right, John. These are changed beasts. And I think one of the problems we have, and frankly Washington has, is the size of these companies. I'm trying to always bring ratios into this. I don't have them in front of me right now. I can't look smart. But can we keep in mind that the total assets of JP Morgan published is $3.7 trillion. And you can add them up on the 4 here, but I think one of the great canards of financial media is to not explain to people these things are huge. John, what is the employee count of JP Morgan? I mean, it's not Walmart, but it's 288,000 people.
Yeah.
It's
a lot of people.
And I just think there's not, I'm sorry, to me, they're almost hiding profit here. They're granted, they got the worries you talked about. They're really worried about slowdown. Mr. Dimon, I'm sure, will address this today among the others. But the real issue here is they're literally hiding the boom they had in the fourth quarter of this year.
The stock's a little softer, lighter in the pre-market. The overall equity market's down about 0.4%. There's another name to look at this morning. It's Tesla. It's down a little more than 5% in early trading. I'll bring you some Southside research in a couple of minutes' time. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Germany, the economy probably stagnated in the fourth quarter. That's easing fears that the war in Ukraine and inflation have triggered a recession. For the year, GDP rose 1.9%, just ahead of the estimate in a Bloomberg survey. President Biden's handling of classified documents erupted into a political crisis with potential legal repercussions. A special counsel has been named to investigate. Meanwhile, the White House has confirmed that a second set of documents was found in a garage storage area in the president's home in Delaware. Japan's Prime Minister Fumio Kishida will seek public support from his new security strategy today from President Biden. The two leaders will meet at the White House. Several weeks ago, Japan announced a radical upgrade of its security policy. It includes a 60% spending increase and plans to acquire missiles capable of striking China. Tesla is slashing prices in the U.S. and major European markets after several quarters of disappointing deliveries. The electric car maker lowered the cost of its cheapest Model Y by 20%. Buyers can save as much as $21,000 on Tesla's most expensive vehicles. And the only child of Elvis Presley has died. Lisa Marie Presley had been rushed to a hospital in a Los Angeles suburb Thursday after suffering cardiac arrest. She was a singer who earlier this week appeared at Graceland, the mansion where Elvis lived in Memphis, Tennessee. Lisa Marie Presley was 54. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Season is here.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
As inflation is coming down, take-home pay for workers is going up. Workers' wages are higher now than they were 7 months ago, adjusted for inflation. Wages for lower-income and middle-income workers have gone up even more. It all adds up to a real break for consumers, real breathing room for families.
That was the President of the United States on the latest inflation numbers in the last 24 hours. Your equity market looking a little something like this morning. Good morning to you. We are negative by 0.4% on the S&P 500. Yields are a little bit higher by 2 basis points on a 10-year, in and around 346. The banks to look at this morning, you know them so far. The numbers from JP Morgan, Wells Fargo, B of A behind us. The one out here that I think we're all looking at is JP Morgan, down by about 2.3% in the pre-market as the outlook.
It's the outlook, yeah.
Net interest income outlook misses estimates. We'll build on that story a little bit later. Ken Leon's going to come back from CFRA in about 40 minutes, and we'll talk to him about the financials when we get Citi. Outside of that, I want to talk about Tesla. Tesla with some price cuts. I mean, we're talking not just 5%. Not 10%. We're talking about 20% price cuts in Europe and in the United States. Tesla's down about 5%. I promised you some Southside research. Here's some from Wells Fargo. Tesla likely to lose its tech-like valuation. Tom, that's the problem. They say this over at Wells Fargo. There is growing debate among institutional investors on how to value Tesla, auto, or tech. Their price target gets cut to 130 from 230. So that's a big price target cut, but still this stock's at 117.31. You want a bullish view, Tom? Dan Ives, Wedbush, still outperforming the stock, says this. We believe altogether these price cuts could spur demand deliveries by 12 to 15% globally in 23, and shows Tesla and Musk are going to be on the offensive to spur demand in a softening backdrop. The question is, Tom, who else is going to join them?
TV, turn up the volume, and radio, good morning to you. John, estimated PE off the Bloomberg. Tesla's still rocking just above $100 a share. A 30 PE multiple. Ford, GM, 7 and 5.
Yep, there you go. That's the story. So where does it fall? Does it gravitate towards them?
Oh, where's the surveillance court? Oh,
he's not going to speak.
They were banned. They were, you know, I'm not going there, John. You know where I stand on this. You busted my chops. But all I can say is the stock is well behaved in a southern direction.
Down another 5% this morning. We'll keep you up to speed on some of those price moves.
Anne-Marie Horton does not drive a Tesla. She's our Bloomberg Washington correspondent, which means she always takes Ubers and Lyfts in Washington and joins us this morning. If you were to Uber, Anne-Marie, and I think a huge political story not reported in the oddities of January after a midterm election is Virginia. And if you go south to Virginia Beach, it is one of the great purple areas of America. And the governor of Virginia, I believe, had a modest defeat over the week. And this is this Republican to Democrat, Democrat to Republican tilt. That infects every conversation in Washington, doesn't it? That going forward to the 2024 election, it's very purple out there, and importantly, purple out there.
Well, first point, Tom, no one wants to see me behind the wheel. I can assure you that. Second point, it's true. You're going to hear names like Youngkin, like Sununu, obviously. Also the likes of, as we talked about a lot, the governor of Florida. Because we go into 2024, the Democrats and the Republicans are trying to figure out who is going to lead the party. Obviously, for the Democrats, it's a little bit of a different situation because they are in control of the White House, and President Biden has, or his chief of staff, have pretty much said that he will be announcing a presidential run for 2024. But now the Republicans have kind of put the former President Trump in the back seat. And his campaign, I know he's going to be doing something at the end of the month in South Carolina, but his campaign has almost kind of evaporated. It really has become to the back pages of the news. You're going to hear the likes of a Glenn Youngkin. And it is important because of his proximity to Washington, D.C. People pay attention to Virginia.
With your encyclopedic reading, and folks, Anne-Marie's doing this 24/7. We bust her chops about it, but she's got the zeitgeist going in Washington. What is the Republican response to narrow Democratic victories like this small election in Virginia Beach the other day? Do they go with the names you mentioned, or does MAGA still have a value in the Republican Party?
I think it remains to be seen what they do for 2024, but I think it was on display that MAGA has a control of the Republican Party in the House of Representatives, where you saw 20 individuals that are very conservative, some of them incredibly conservative, fringes of the far right, basically hold the speakership hostage for days because they wanted concessions from Kevin McCarthy, or frankly, they just didn't want to see him being the speaker because they feel like he doesn't have those conservative values when it comes to ideology. So you cannot say that these, even though if you look at the broad spectrum of America and who would make more sense for 2024 in terms of making sure you get those moderates and independents to vote, which basically swing the election regardless of who it is, the fact of the matter is there is a massive control of these far right in the Republican Party, and they've been dealing with it for years, since 2011, since 2015, but we saw it on display just last week.
MH, let's just talk about the former president just for a moment as well, and his campaign. We asked some questions over the last couple of weeks, just what was happening with that. How's that shaking out at the moment?
Well, we know that he's going to be doing some sort of campaign event, not a rally, but he will be doing some sort of campaign event at the end of the month in South Carolina, which will be key for the Republicans in terms of 2024. But besides that, there hasn't been a lot from the former president. Obviously, he had his Nifty deal, the Nifties, NFTs, yes. Then he also is on Truth Social. He's obviously come out and lambasted what's happening with this president in terms of classified documents, but they haven't had these huge rallies. There hasn't been main fundraising events for him, and pretty much it's a campaign, what it feels like, a campaign in name only.
AMH, thank you. Anne-Marie, down in Washington, D.C. A campaign in name only at the moment. Anne-Marie's words down in Washington, Tom.
I was fascinated by these elections, and I read very briefly on the Virginia Beach story, but all my focus with our wonderful Greg Giroux, who's just encyclopedic on this, are on these smaller state elections are off the media's radar that are purple, purple, purple. And it's I have no idea how that's going to cut, but that's where my study is.
If you are just tuning in, let's run things through for you, or run through things for you.
You nailed that. You sounded
Get through
like me.
that. Got to learn how to talk again, Tim.
Yeah.
Equity futures down about 5 or 0.6% on the S&P. My apologies for that. Your bond market yields higher by about 2 basis points. Let's call it 3.46 on a 10-year at the moment. I want to talk about a couple of names. Let's start with the banks. JP Morgan, Wells Fargo, Bank of America. I think if you wanted one broader story this morning, Wall Street banks preparing for tougher times ahead. Whether we get those tougher times, though, I think is a completely different question, and that's the question we're all having in broader markets, the debate we're having every single day. Do we get a slowdown, a recession? Do we get a recovery, driven by what's happening in China, in Europe, and elsewhere as well? And Neil Dutter of Renmac, who's been saying this repeatedly, over and over again, week after week, what slowdown? We've had a re-acceleration in the last quarter of 2022. Beyond the banks, I want to talk about Tesla cutting prices 20% in Europe and in the United States to try and boost demand. And Tom, you mentioned this, Ford, GM. If Tesla's going to go 20, who goes next?
Yeah, I don't. I mean, I think that's so convoluted. Our wonderful Detroit team can really tell us about the product mix in EV. I'm just flat out not up to speed. Torsten Slok with us yesterday publishes moments ago, John, and this really folds into the Dutta view. Slok, Apollo. Combined with continued solid job growth and robust wage inflation, the bottom line is that there remains a powerful tailwind in place for U.S. consumer spending. I would suggest into this weekend in our reading, that's a percolating idea.
That's exactly what we hear from Neil, and that's exactly what we're hearing from other people. And the people that didn't share that view a month ago
are shifting.
They're shifting, and why they're shifting? Because this market's shifting. The market's setting the tone for that debate, Tom.
The market is out front. I mean, the market's always out front of this. I mean,
As we're talking, though, equities are rolling over. We're down about 0.75% on the S&P 500. Citigroup numbers about 35 minutes away. Shinali staying close. Ken Leon of CFRA coming up a little bit later. From New York, this is Bloomberg.
climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Live from New York City, equities down 0.75% on the S&P 500. On the Nasdaq, we're down about 0.8%. Just equity softer here off the back of bank earnings this morning. So let's talk about those bank earnings and the outlook as well. The outlook critical for stocks like JP Morgan, down about 2.63% in the pre-market. The outlook for net interest income. Bank said it expects about $73 billion for NII in 2023. The estimate was $74.4 billion, preparing maybe for tougher times ahead, Tom. We've seen that reserve build across the banks this morning. B of A down about 1.4%, 1.3%. Wells Fargo down by 3.7%. But both Wells and JP Morgan setting the stage for some share repurchases, Tom, through the year.
The share repurchases, I think, speaks to the prosperity of the moment. But, you know, in their defense, and I think the conference calls will be fascinating and really hearken, John, to the entire earnings season. People are really going to have to lean forward and get the nuances of where are we in May? Where are we in August? We don't have a clue. They don't have a clue.
Where are we at the end of the first quarter?
Oh, yeah. Well, that's the fair,
at the end of
March outlook.
I've got no idea at the moment. I don't think many people do either. Let's talk about Tesla. That stock's been hammered over the last few months. Tesla in the pre-market right now is down another 5.63%. Waking up to the news of more price cuts in the United States, in Europe. Price cuts of 20%. Tom, that stock at 116 and down by 5.6%.
Bears incredibly careful analysis, and forget about the Musk soap opera, folks. Just on this simple case of who owns it and the index funds that own it, that's going to be painful with a continued glide south. I'm not going to pontificate of whether we're going to see $99 per share. That would be rude. So, you know, that's where we are, John. Futures at -30, Dow futures -95.
That stock, Tesla, down by 67%. Off the April peak. That is quite a move. We'll bring you some more on that a little bit later. The latest inflation data showing that inflation continues to cool in December, leaving investors questioning the Fed's path forward. Lindsay Rosner of PGIM Fixed Income weighing in, saying the following: the report is consistent with our expectation for a 25 basis point hike on February 1st and a final hike of 25 basis points on March 21st to bring the peak policy rate, Tom, to 4.75 to 5%. How attainable is that 5 handle is the question we're still asking.
This is a really, really important conversation. We don't do this enough. This is sort of what afternoon TV and radio do. It's not the province of the morning, but we're going to do it because this weekend across this nation, a huge body of the nation is going to reallocate their retirement plan disaster. Lindsay Rosner is a student of this, a CFA, a small college in New Jersey. She darkened the door on years ago. And Lindsay, I'm going to cut to the chase. PGIM, Greg Peters, and everybody else in the industry is picking up the pieces from a complete disaster of 60-40 allocation, 60-30-10. And what PGIM does, and I don't mean to pick on PGIM, but core this, core that, core the other thing as well. How do you reallocate after the debacle of 2022?
Right. Well, I think you're right. It was a debacle in 2022. Nobody can deny that. But I think what we've got now, we know what this painful journey led us to, is an unbelievable opportunity in the fixed income market. You actually have an opportunity to do the right thing and the safer thing. We've been in a world for so long where the requirement to get any kind of return was to go out the risk spectrum. You don't actually need to do that now. You can get 6-7% yields in high quality assets. So I think the allocation, and I'm biased as a fixed income manager, is bonds.
I mean, I think, Lindsay, what's so important here, and of course you on the high ground of this, let's call it CFA level 3 territory, folks, where your eyes glaze over. But the bottom line is, do our listeners and viewers want to manage more towards an index fund with an R squared of 0.9 or even higher, or do they want to get a little more supple and flexible this year, not like something like Kathy Wood's ARC, the train wreck that is, but do you want to be a little more active this year or indexy?
You want to be active. I think we say we love bonds, but we don't love all bonds, and neither should you. This is a year of security selection, especially as we face a recession. There will be winners and there will be losers. And you need an active manager to sort that out for you.
Well, let's talk about that right now, Lindsay. Let's have that discussion. What are you looking for? What's on the list?
So things that we really like are high quality structured product, great credit enhancement there, that even if you have problems in, for example, some of the underlying loans in a CLO, you're protected. Also select names in corporate world, investment grade and high yield. There's a lot of opportunity to be had, a lot of yield, but you need the resources to analyze the balance sheets.
Let's go through high yield then. So I'll bring up high yield spreads more broadly, and you can go a little deeper and tell me what sectors, maybe even what names you're looking at. High yield spreads have come down to about 420. Lindsay, this is not for your benefit, it's for the benefit of our audience that might not follow this asset class. But the wides a year ago, the wides back in the summer were 583. So we've tightened a tremendous amount at a time when people are trying to figure out if we're going into recession or not. So what do you like in that lower quality cohort of US corporations?
Yeah, it is really name specific. And for example, there are some in the higher quality, I know you're asking lower quality, higher quality fallen angels that we think become those rising stars. But then it is names, specific home builders we really like, which kind of sounds crazy with mortgage rates where they are. But it's about picking those out. And I think the key thing is that the default projections are extremely low. The recoveries are higher, probably going to be higher than they were historically. These are all good things for high yield writ large, but you got to get those names right at these tight spreads, to your point.
Yeah, Greg emails in from New Jersey and says, and Greg wants to know, Lindsay, are we clipping coupons or are we going for total return this year? Help Greg out.
I try to. That's part of my job. You know, we can clip coupons. We've got a ton of spread if we just stay static. But you're in a case where we are a total return manager. You know, so we're going to keep looking for opportunities. Is that helpful to Greg?
Yeah, that's very good. You nailed it. Okay, let's keep this going. Well, folks, you don't see this on radio, but behind Lindsay's all of the Nassim Taleb she's read over the years. I'm sorry, the world's changed. You know that. All of a sudden, the Sharpe ratio matters as well. Our viewers and listeners have to deal with a new cost of money. I get it that bonds are the place to be, but what's the recovery line back to 2020 or 2019? Do you and PGIM have a 3-year vision to get back, or is it a 5-year vision to get back?
Yeah, it's longer term, right? We're longer term investors. That's what we do. I think a lot of people are quibbling right now is GDP, for example, in the U.S. next year, 0.3, is it 0.6%, is it 0.5, and they're going to change it potentially even on the print we had yesterday. Let's pull the camera back and think long term and buy the right companies, the right collateral that's going to do well, and pick the spots that are going to have the right kind of recovery.
Can we talk about allocation to bonds from a cross-asset portfolio construction perspective, Lindsay? People may be looking to allocate to bonds back into that traditional 60-40 this year, and I think we're still trying to figure out what snaps that positive correlation between risk equities and between traditional fixed income, say sovereigns. Do you think that breaks this year? And Lindsay, why do you think it does break? What leads to that?
Yeah, I think it goes right back to what Tom just said, which is we had 2 black swans. We just had COVID and we have a land war in Europe. So those are things that when you're looking at a theoretical model, black swans aren't part of it. And we had a very much black swan style year. While we certainly want to think about the risks or the unknowns, but I think we're going to enter a more normal time. And that's important. And that's where those correlations you've historically studied come back into play.
The challenge to that view, if I can provide it, and I'd love your comment on it, the same reasons that we're seeing equities in emerging markets rip, copper rallying aggressively, European banks up a lot, the same reasons I think you could make the argument that yields should be higher, that we're seeing a more resilient economy than expected, that these central banks will have to go further, the ECB being one of them. We will get that growth impulse off the back of China reopening. Lindsay, why doesn't that result in better risk profiles, equities up, credit spreads tighter, but also treasuries going lower and yields still going higher from here through this year?
Yeah, I think you're bringing up the risk case that is not priced in. So what I think is pretty incredible, if you just look at what's implied in the forwards for February, the forwards are saying the Fed's going to hike 27 basis points. And this is the way I'm answering your question. I can already answer it another way as well. But 27 basis points is saying that everybody knows what the Fed's going to do. And they know what it's going to do going forward. And despite what it's telling you, they're going to pause, they're going to cut. Why are we so confident now? Everybody was wrong last year. And so I think your point of that risk of inflation actually being more persistent, the economy being more robust, China fueling the economy, which is inflationary, that is a concern. We can't deny it. The Fed can't be on autopilot cruise control. And by the way, neither can investors.
Lindsay, this was great. Just fantastic. I'm not sure what's happening over at PGIM. Why do they have such a fantastic lineup? Lindsay Rosner, Mike Collins, Greg Peters,
you seriously want to
Robert
get me
Tipp.
going on this? Prudential.
What a fantastic
Walter
team.
Cronkite used to come on 50 years ago, brought to you by Prudential, whatever, the voice was. And PGIM came out of an insurance company that just always led with academics. And when you line up the PGIM people, and no one in the industry is surprised when they won every Morningstar Fixed Income Manager of the Year award.
A couple of years back.
A couple of years back. I mean, nobody, it's like PIMCO. It's academics first. Rosner is simply lights out. She's Princeton University, CFA. She's the real freaking deal. And that's what matters. I mean, you got to have the intellectual context there. I mean, Greg Peters is lagging behind a little bit, but that's a different story.
He's going to write. He's going to catch up.
Do you have him in the 9 o'clock
he'll
today?
Catch up. No. I think he's interning for Lindsay.
Yeah, well, it could be. That was brilliant, folks. That's what you need when you're saying to yourself, "What do I do with my 201k?" I talked to John Tucker this morning.
It's a 201k.
It's a 20. Tucker's back to a 201k
after last year.
He says, "Tom, can you hold my hand while I open the envelope?" And then we're going to do that.
Well, you joke about that. You joke about that. I wonder how that's gone down for a lot of people. How they've experienced that in the last 12 months.
John, I've extended my retirement date out to 2030.
I don't think you're alone. You're going to be around that long? Another 8 years?
Well, I don't know.
7 years.
Shonali's in the way of my walker here. I can't get to it on the break.
Let me grab it for you.
Oh, thank you, dear.
I always say I'll be the first one to go before you. You'll be the last one standing.
Lisa's, where is Lisa? What are we doing with Bramo? You were like doing a high yield.
Bramo's skiing.
She's skiing.
You keep saying that we're on assignment whenever we take a day off, but Lisa's skiing.
Bloomberg reports.
Lisa, I don't know where she's skiing, but Bramo is skiing. She's quite a keen skier.
She does those helicopter things. She goes up
you
in the
drop
helicopter
off and then you go off piste.
They drop piste. Is that how you pronounce it?
You go off piste and then you.
Oh, that was paste. I'm sorry.
No, you go off piste.
Okay.
And then you know.
Derby, Manchester.
Manchester Derby this weekend. North London Derby this weekend.
The Blues have to be favored, right?
When are we launching our sports podcast?
I think we're doing it Sunday.
When are we doing that?
We're doing it Sunday. Important Derby. Mr. Leviano, thank you for the ticket offer. Really appreciate it. I don't think we're going to be there.
Should we do a Twitter Spaces as that game is on?
I don't know
Would you
what
like
that
to do
is.
that?
What's
Shonali does
Twitter
those.
Spaces?
Shonali does those.
I do.
We should do one of those.
Do you do Spaces?
I sure do.
You sort of go on and we'll just sort of chat and people can drop by and listen in.
How social.
They can take our commentary instead of the commentary on Peacock and NBC. John Rochester of Nomura coming up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Alabama and Georgia, violent weather killed at least 7 people. Much of the damage took place in Alabama, where a tornado cut a 20-mile path across 2 rural communities. 6 people were killed and more than 3 dozen homes were damaged or destroyed. China's exports keep falling and global demand continues to drop off. Exports in U.S. dollar terms declined 9.9% in December from a year earlier. That was better than expected performance. Still, it adds pressure to an economy that's trying to recover from COVID-0 restrictions. The FAA is out with preliminary findings on the computer failure that grounded all departing U.S. flights on Wednesday. The agency says it was caused when a data file was damaged due to a failure to follow government procedures. Now, according to the FAA, unspecified personnel were responsible for corrupting the file. Delta Airlines is forecasting first quarter profit that fell short of Wall Street estimates. That's a setback for the carrier's efforts to capitalize on a rebound in air travel demand. Delta is being hit by soaring labor costs. And a big pay cut in the works for Tim Cook. Apple is reducing its CEO's compensation by more than 40% to $49 million this year. The company is citing investor feedback and a request from Cook himself to adjust his pay. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
The Fed's policy has been able to keep inflation expectations under control and has returned inflation expectations to levels consistent with the 2% inflation target, and I'm now expecting actual inflation to follow behind.
That was Jim Bullard of the St. Louis Fed. So we've got the Boston Fed, the Philly Fed, teeing up 25 basis point hikes. And Jim Bullard comes out and says, yeah, that 5% number, let's get there like tomorrow, Tom. Tomorrow. Why wait? Unreal, isn't it? You're speechless.
Unreal, and was it better decades ago when there was less regional chat? And I would be honored to sit with the PhD from Indiana. Huge respect for Jim Bullard. He really made people think with an important research paper on regime change, I'll say a decade ago. And the bottom line is, John, review this. Bullard was moving us up 5, 6 headlines of 7%. And now we're managing the message down to 5.x%. Is that the job?
Projections. That's in their projections.
Okay, but I think, yeah, McKee would say it's in the dot plot, you know.
It's in their dot plot. Look, the difficulty they have at the moment is that they are looking at the data, it's coming their way, seeing some disinflationary trends emerge. Unemployment's still pretty steady at 3.5%. The labour market is arguably looking at the data pretty tight. And they're trying to wander around, Tom, whether they need to be tighter to keep financial conditions tight or whether they can just settle on right where they are. Another 25 basis point move and pause.
Our audience is cruel, you know.
What are they
I
saying?
get all the hate mail, but, you know, and we've got a guest coming on right now who's perfect for this.
I can always tell when you're distracted and aren't following anything I say.
I'm looking at Twitter Spaces with Shanali.
Okay.
Ben Twaden's here, and he puts us out with our title for our soccer thing. Soccer for Dummies is what we're going to call it. Thank you for that. It's really good to know. And our first guest can be the guest right now when
there's
we do
another
Soccer
tweet here
for
as well.
Dummies.
Bloomberg TV would get pulled over for drunk driving every morning without Farrow acting as the designated driver.
Got that right.
I think that's the only reason I'm here. Equity futures right now on the S&P, negative 0.8%. Jordan Rochester over at Nomura had this to say on the euro. We've seen some real dollar weakness come through in the last couple of months. Here's the quote. Expect better European data, inflows, terms of trade, falling US CPI, and more to boost euro dollar, Tom, towards 110 in short order, 116 by year end. Now in mind.
Euro dollar there. We'll get to that in a moment. Right now, important to speak to Mr. Rochester of Nomura here about what will be the study over the weekend. He has to be delicate. He is with Nomura, a Japanese bank. Jordan, it is just flat out there. Suddenly, the death of yield curve control. Explain the ramifications for global Wall Street ex-Japan. If Japan gives way, if the Bank of Japan has to somehow normalize rates, what's it mean for the rest of us?
It means a lot, Tom. If you think about what Japan's done, they've had quantitative easing for over a long period of time, much more than what we've had in Europe and in the US. So first of all, those carry trades that have built up over the better part of a decade or longer could be unwound, and it could lead to fixed income markets having a tightening in terms of credit conditions, and therefore it's not clear how risk sentiment would do well if they were to suddenly abandon yield curve control. Number one, how does the local market handle it? How much do JGBs sell off?
Right.
Is fair value around 85 basis points? That's a significant daily sell-off. But you know what markets are like in these sort of shock scenarios? You can get a sort of non-linear market reaction. Then it feeds through to US Treasuries. One of the largest buyers, one of the largest holders of US Treasuries outside of America is Japan. So how well do Treasuries handle the Japanese having tighter conditions, higher yields in Japan, making US fixed income less attractive? The sort of answer is it would lead to quite big sell-offs, I think.
Because the sell-offs here speak volatility. Ben Emmons over at Newbridge talks today about China exporting disinflation when you work through the dynamics. If we work through the dynamics of the end of the Kuroda experiment, does a much larger, healthier Japan export disinflation or the opposite?
Well, the world's very much globalized. Let's walk through the sort of path of how that could play out. What we're seeing is the first chance in a long time for Japan to have animal spirits and to escape the trap of deflation. We're seeing huge pay rises from certain retailers. The big headline for me this week was Uniqlo, the 40% pay rise, the first time they've raised pay in 20 years. 40. That's a massive number across the board. We're seeing other companies doing big numbers, but much less extreme, like 6% or so. The shunto, it's called, the wage negotiations, they all come up to us around March time. Do we get big pay rises overall for the whole of Japan? Then we could see inflation become a bit more of a topic that Japan's not had for a long time. What does that mean for the rest of the world? It means that we have one of the last few central banks doing quantitative easing coming to an end, if that was to happen.
Well, Jordan,
it's not our base case, but it's something to watch out for and a big risk for this year.
You've said it. They see it as a once-in-a-generation opportunity to reset inflation higher. We see it as potentially a policy mistake on the horizon. And, Jordan, they've got to figure out what kind of policy setting is sustainable. Now, I thought that was the effort just a month ago. And now there's a conversation about maybe renewing that effort in a week's time. Jordan, what is it?
Well, the base case from us is that we shouldn't get much of a change next week because of these risks we've talked about. But there's a trade-off for the central bank, which is, are the benefits of yield curve control, which are leading to Japan having to do massive amounts of quantitative easing to defend that target, are they working against the potential positives from it? So are those positives becoming negatives? So let's just bear in mind, Japan is experiencing inflation. It's nothing like Europe or the US, so it's still quite low compared to our standards, but it is high for Japan's standards, and we're having wage gains. So is the yield curve control, which is forcing them to do quantitative easing, working against the idea of inflation going up, and therefore maybe they should tighten. That's the problem of the policy. That's the bind they're in. It's just how quickly do they exit it is the problem for markets. There's some speculation it could happen as early as next week, hence we're getting these big dollar yen moves. For us, it's a little bit too soon. We've got a new governor coming up. The new governor will start probably from April onwards, but it is though the risk for next week, another surprise from the Bank of Japan, and that's why for us it's just easier to have a short dollar yen trade on rather than talking anything specific about on this date this will happen.
Well, it's a break at 130 right now. We've gone from 150 to a break at 130, 129, 128. That's dollar yen. Cable's gone from 103.50 at the lows at the end of September all the way back through 120. Euro dollar's gone from what, 95 through 108. You're looking for 110, 116. Jordan, can we just sit on this just for a moment? What did the FX community get so wrong at the end of September? I remember the conversations we would have. We were talking about parity, perhaps, on cable. We got close. Euro dollar, getting used to life below parity. Look at us now. What changed, Jordan?
I don't miss last year at all, John. It was doom and gloom, and I really didn't enjoy being right. So we got the euro dollar view right, we got the cable right. We had a really good year in terms of P&L on our trades. Gloom, it was recession. It was European energy prices spiking to unbelievable heights. The trade balance of the euro area collapsing for the first time in a generation to levels that were wider than the US in terms of GDP. What's changed, John, is we've had a few factors work in the euro area's favor. Number one, we've had energy prices collapse. That has been a massive tailwind for industry. It's allowed all those steel, chemical, manufacturing plants to turn back on production. It's why we're seeing European data start to improve. Number two is, thank you, Mr. US. US inflation's now decelerating. We could have goods deflation this year. That is a very different story to last year when US inflation was accelerating, and the story is about how much hikes will the Fed do. Now it's about when will the Fed stop and when will they start to cut. We think from September this year. So I think a lot's changed on the ground in terms of facts. And then the third factor is China reopening. That's the new one. China reopening is a bigger deal for Europe than it is the US. US exports to China is less than 1% of GDP, 0.67% to be exact. For the German economy, it's more than 3 times more important. It's around 2.67% of German GDP, just exports to China. Your biggest trading partner reopening its doors, opening up its tourism flows, makes Europe so much more attractive. Now, with those energy story and that inflation story in the US too.
Hey, Jordan, thank you. Jordan Rochester.
Thank you. Just superb.
Tough time for FX over the last couple of months. What a change in trend we've seen.
What he described there, and this is, you know, you say to yourself, how do saxophone players get hired at these big fancy banks?
He is a saxophone
player.
What you heard
there on Japanese dynamics is PhD level dynamics. That's what all these people do, whether it's Jordan Rochester, Sarah Vallis, or the giant Steve Englander over at Standard Charter. And the answer, John, is people go, okay, so what of yield curve control in Japan? It's 12 hours away and I haven't been to Tokyo because of COVID. It really, really, really matters. And those dynamics impute across the time zones to us.
If anyone was wondering how saxophone players get hired at banks, Tom, that was a key question for me this morning.
Yeah, no, I did.
You know, my favourite hiring story, Greg Peters, you mentioned him earlier, hiring Andrew Sheets because he liked extreme frisbee and could draw cartoons.
Well, that's a Brown University thing.
Isn't that the greatest
Sheets was in
hiring
Brown.
story?
Sheets spent the entire time at Brown in pizza parlors wearing Birkenstocks.
Is that right?
That's right.
Okay. From New York, this is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio.
When I started, I had no idea it was going to turn into this. Which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand. Could still avoid a recession.
I think the real story starts around the second quarter of the year when we start to see if inflation can meaningfully and easily push through that 4% barrier.
We should expect to see the Fed begin to cut rates, maybe not in the third quarter, but definitely, in my view, in the fourth quarter or going into next year.
If a year from now inflation is too high and inflation expectations are too high, the Fed will see that as a policy mistake.
The long lag, variable lags of Fed policy, it's still working its way through the system.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome you on a bank frenzy. We've heard from early banks, and now we hear from Citigroup as well. We do this futures negative 34. JP Morgan a little off the mark. Solid earnings, and then the view forward for Jane Fraser. John, will be a mystery.
Well, let's talk about the earnings so far for Jane Fraser and Citigroup this morning in the fourth quarter. We can start with investment banking revenue. That comes in lighter, $645 million. The estimate, $722.4 million. Going through the earnings release, this on equity sales and trading revenue, $789 million. The estimate, $930.6 million. FIC. There's a beat, $3.16 billion. The estimate, $2.81 billion. Advisory revenue, $269 million. The estimate, $340.8 million. If we can look at the share price, the stock down by about 2.2%. Shanali Basak, our Wall Street correspondent, alongside us. Shanali, your thoughts on these numbers?
A few things for you here. Even though you had that beat in fixed income trading, we wanted to see it. It's good news for Citigroup. There's a lot of things here that you have to pay attention to. One of them being the fourth quarter return on tangible common equity of less than 6%. Now compare that to the other banks. That was 20% over at JP Morgan. Comparatively, that's less than 6% over at Citigroup. So the challenges still remain ahead to turn profitability there when you look at Citigroup. Revenues increased a mere 6%. 4% from the prior year, 5% when you include divestitures. But remember, this is a bank that's still in the middle of a turnaround story. You are not seeing that stock react positively there. Remember, Citigroup has been trading very, very sluggishly lately. It's at about half of its book value when you look at how its performance has been moving forward.
The profitability here, and Jane Frazier's how long, a year into this?
More than that now.
More than that now. How do you adjudge, and the experts you speak to, how do they adjudge her timing of change strategically and tactically at Citigroup? What's her timeline?
She has years ahead of her, and part of that is because they're still dealing with regulatory challenges. You know that Citigroup, the technology issues that they've had has been a decade plus old, and it's led to some serious mishaps when you look at some of the trades that have gone awry when you look at Citigroup. So she has a technology story to turn around, she has a regulatory story to turn around, and she has a global footprint to turn around. And that's where she has already made a lot of progress by exiting a lot of business lines in some areas that don't make sense for Citigroup anymore.
Overall revenue, $18.01 billion. The estimate is $17.96 billion for the fourth quarter. Schneider, looking back beyond the fourth quarter, the whole year, it's a pretty decent year for Wall Street banks. Looking ahead to the year ahead, I've got no idea what 23 looks like.
You have to ask yourself where the money comes from, because if margins are under pressure, you still see pressure upward on headcount, down on pay, but up on headcount. You still have to ask yourself, you know, if JP Morgan is bringing in less money than expected, more money, but less than expected in net interest income, you know, how do they please Wall Street? How do they please their own investors as they try to invest in these businesses? This is becoming a hyper-competitive share gain here in a market that is not growing as meaningfully as would warrant.
I just looked at the FA screens in the Bloomberg, and I think we need to frame the size of the banks and the relative size of the banks. Wells Fargo is obviously a different story with a huge restructuring off housing. Citigroup, on a quick ratio of operating income or net income, I can't remember which, is basically 40% the size of JP Morgan. How does she get critical mass at Citigroup to compete? I don't get it.
One thing to watch, both for Citigroup as well as, frankly, for Goldman Sachs on Tuesday, is that focus away from traditional banking into asset and wealth management, particularly wealth management.
So she wants to do a Gorman. Why doesn't she just merge with Morgan Stanley and move on?
Well, they're too big. And the reality is that's where I'm giving you the global story. I think for Citigroup, because they're the most global of the U.S. banks, you have to watch how she gains share in asset and wealth management at a time where the globe is in a pretty tough spot.
So she's competing with Credit Suisse, and particularly the new Credit Suisse, right?
Credit Suisse, UBS, more than Morgan Stanley, which is virtually non-existent globally in wealth.
I'm just fascinated by this. And the traditional way we report earnings, we're 14, 15 years on from the great financial crisis. And here it is on radio. I got my hand up. JP Morgan's here. There's 4 or 5 other banks down here. And Citigroup is down here on the table where, you know, we store the Tang. I'm sorry. I don't understand. If I was talking to Jane in Davos, or David Weston with Jane Fraser on Davos early next week, the bottom line is, I don't get what the mission is at Citigroup.
Can I draw a question also? You know, if I talked about wealth, that is one area. But if you look at this core institutional business here, even when you look back at JP Morgan, it's amazing to see how many misses you saw in the institutional businesses. I'm not just talking about fixed income trading for them. We saw Citigroup beat there, but I'm talking about investment banking. That drop off is way worse than anyone expected when you look at even JP Morgan, and it spells the question, do those things come back? Do they come back meaningfully? Remember, Citi cut some headcount there.
Just quickly, compare the reserves, the build elsewhere, and what's happening with Citi. What's the difference here?
The difference for Citi is the global nature of the business, John. It's kind of as simple as that. If you take a look at it, really what they're accounting for here is not just the American consumer, but when you look at Citigroup, the question of the reserve build, the question of putting it behind you, right? The reason people will think that's a good thing, even for Citigroup, is a lot of those builds come from credit cards. And that credit card business is also a league table game when you look at Citi and JP Morgan.
Citi down right now by 2.9%. The broader equity market down by 0.9%. Citi sees 2023 a modest rebound, Tom, in investment banking and wealth, a modest rebound. Dare I say that's slightly different to some of the outlooks we've seen so far, Tom?
Yes, and I think that after what we talked about with Torsten Slok and Neil Dutta, there's a raging debate into your weekend reading here about what the view is forward. Off the inflation report.
Neil scathing this morning.
Neil, he doesn't mince words. In his headline of his morning note, Mr. Dutta at Renaissance says the Fed outlook and consensus is just ludicrous. He feels they're way too gloomy. I don't think we're going to hear that in the conference calls, but it's a point to bring up. As well, I would think that Davos will go opposite of that, and you'll get maximum gloom at Davos this year.
Then I think a lot of people are tempted to go the other way.
Well, I'll be with Barry in the piano bar trying to survive. Right
now,
now,
going, are you?
Yeah, right now. Well, we'll see. Ken Leon joins us right now with decades of experience, and he can take us back to the 10-to-1 reverse stock split of Citigroup 14 years ago. Ken, 15 years ago. Can Citigroup and Ms. Fraser, with all of her wonderful abilities, can she strategically